Alrighty. Ready? I call this meeting to order.
First up would be the minutes.
Okay, you're waiting on me here.
Yeah.
Okay. Welcome everyone. And do we have any? I do have.
Recording in progress.
Oh, it is. Yes. Okay, the minutes. We have minutes from October the 11th, the board meeting minutes. Has everyone had a chance to review them? Do you have any corrections? No?
I move that we approve the minutes as submitted. And then there was something on here that, on the minutes, it said that Ann Malkin abstained from accepting the minutes, and I was wondering if that was.
Yeah, it was because I wasn't at the meeting, so I didn't have any,
Okay.
yeah, I couldn't vote, yeah.
Okay, do I have a second?
I'll second.
All those in favor?
Aye.
All right, we'll move on from that. Public comments, do we have any members from the public that would like to speak?
We do not have any here and none online.
None online.
Right.
Okay, good. So the first thing that we have is monitoring financial conditions and activities, an external audit.
All right, thank you. We are joined by Brenda Bartlett, our third-party auditor representing Sensiba. Hi,
Hi
Brenda.
there. I'm here. Thanks for having me. I do not know what order the board packet's in, Robert. Do you want me to share my
yes.
screen in order to just kind of go through the way I'll go through it?
Do the board members want it to be projected to screen, or would you like to just follow along with hard copies from the board packet? This is the letter to the board members plus the annual financial statement.
Yep, we'll start with, and we will start with that annual financial statement, the bigger packet, with our letter that starts on page 1 of, the official page 1.
That'd be the one with this cover right here.
Yeah. Okay. So this is our financial statement audit report, which includes our opinion on the financial statements as presented by management. And so you'll see that very second paragraph there indicates that we, in our opinion, the financial statements present fairly in all material respects the financial position of the library as of June 30, 2023. Moving on to that next paragraph, we explain that in order to provide this opinion, we do some work in accordance with our professional standards. We do call out there at the bottom that management overall is responsible for the financial statements. And in fact, in the case of the library, contracts with a separate CPA firm to ensure that there's independence between your audit firm and management, and they assist in the year-end closing and the preparation of the financial statements. Top of the next page, our responsibility as auditors is to obtain evidence to ensure that the numbers that management has provided to us are reasonably stated in all material respects. Some of the things that we do are we like to go to third parties. For example, we'll go to the bank and we'll say, this number that management gave us, is that what you have? So we try to get as much evidence as possible in order to base our opinion to give you as a board and the public that assurance. We look at internal controls, mostly for the purpose, we don't do an opinion on internal controls, but we look at them for the purpose in planning our audit and also to provide management and the board with any kind of recommendations that might come to our attention. There is required supplementary information in the package. And if you've been to one of my presentations before, you'll know I always give a plug to the management's discussion and analysis. It's that nice little nutshell of what went on. And my very favorite part of it at the end is where management talks about what's coming up. What were they thinking about when they developed the budget? What are some economic factors that are expected to impact the library? So one of my favorite parts of a report, and I always tell everybody to read that. We don't give an opinion on that information, but we do read it and make sure that it is consistent with what we've seen in our audit and there's no factual inaccuracies that come to our attention. Finally, this second to the last paragraph, there's a lot of information in that report. And like I said, we do not give opinions on all of it. We give opinions on the basic financial statements, the rest of it that we read, and we want to make sure that it seems to be factually accurate with everything that we know from our audit. Finally, because it's an Oregon municipality, there's some additional requirements in addition to the financial statement. So what I just covered has a lot to do with the financial statement, but we do issue an additional report that have to do more with compliance with laws and regulations of the state of Oregon. So before I move on to that report, which is at the very back of the package, does anybody have any questions on our report? All right, perfect. Then I'm going to scoot all the way to the back, the last two pages. Page 72, and we'll start on page 72. See, I wasn't kidding when I said there's a lot of information in this package. So this is our report required by Oregon state regulations. And the very first part of this is in the middle is sort of a bulleted, bolded list of the things that we are required to look at in addition to the financial statement audit for the library. Some of those things are compliance with making sure that your surplus funds are put into areas and your investments are put into things that are considered safe. So for example, the Oregon State Treasury has a list of banks that have sufficient collateralization to cover public funds in the event of an emergency of some sort with the banking system. So we make sure that you're using one of those banks. We do look through your budget process, make sure that you have gone through the most important steps, publishment, making sure that it's a very public process to the extent that you can, making sure that you've stayed within the appropriations that you developed. We look to make sure that there's insurance in force. We look if there are grants that come in from sources that are restricted to a certain extent. We look at those and make sure that the library has complied with those restrictions. We look at public contracts and purchasing. It's an area of strength of the library, has always been very strong in that area, ensuring that competitive processes are a part of their usual business practices, complying with the law. And then just looking at indebtedness limitations, we have to look at it. This has never been an issue. Even though you've got that large bond, you're within your legal debt limitations. So kind of at the top of the next page, basically we say in connection with our testing, nothing came up to our attention that would cause us to believe that there wasn't compliance with those things that we looked at in that bulleted list. So that's really it for that report. Does anybody have any questions on that report?
Yeah.
Okay. Well, then I'm going to move on. We've got a couple letters this year. I'm going to start with our first letter, which if you see, it will at the very kind of in bold, it'll say our responsibility in relation to the financial statement audit.
It's the longer of the two as well.
Yeah, it's really long.
Not compared to 72 pages.
It's not 72 pages. But this letter is something that gets longer every year that I've been in practice anyway. It's our professional standard setters had, really feel very strongly that we should be communicating more with boards. And so I agree with them. So I have no problem with this 5-page letter. But what it is that we work so closely with management. We spend 99% of our time working back and forth with management, making sure the numbers look good, making sure internal controls look good, but we don't spend a lot of time with you. And yet, you're the one who's responsible ultimately, and you're the one that we report to. So every year we do this, and there's things that they want us to tell you about the audit process. Not necessarily the numbers. Numbers are way back in time. We're almost 5 months out from those numbers, but really about the audit process, what we did, what you can take away from the process as well as the governing body. And so we start out talking a little bit again about our responsibility to the financial statement audit. And that's really a lot what's in our report as well. We're responsible for planning and performing the audit to make sure that we can give you an opinion as to the financial condition of the library as reported by management at year end. We're responsible for communicating significant matters that are relative to your responsibilities in overseeing the financial reporting process. In terms at the very bottom of that level, talking about planned scope and timing, this went fine this year. We had planned to be at this meeting in November and issue before this meeting, and we were able to do that. Things went really smooth in that respect. The top of the next page, some of the things that we really look at in order to plan our audit is looking to see where risk areas lie. So when an auditor talks about risk, they're just really talking about where do we want to spend our time. That really is what it comes down to. What are the most important things in this audit, in any kind of library audit, in any kind of municipality audit, but also in this particular library? What are those things? We look at all of those. And then we also look at the overall effectiveness of the internal control and how that's working in order to ensure that what management's reporting is reasonably stated in all material respects. Let's see. Compliant in the middle there, compliance with ethics requirements. This is our assurance to you that we've complied with all of our ethical requirements regarding independence. And what that means is that we really keep our distance from management because, again, our job is to report to you and to the public. So we work with management very closely, but we don't have any kind of relationship outside of that professional relationship with management or anybody at the library. So it kind of explains that a little bit. Now, the bottom of this page and the top of the next, we're talking about significant risks identified. And I really like to pause here and give you a little bit of context on this, because significant risk is a scary word, right? It's scary terminology. And again, if you go back to the way auditors look at risk, it's really just where we're going to spend our time. And so this is something that we have done as auditors for years. I've been doing this a long time. We've always looked at risk because we can't look at everything. So we want to look at the important things. A couple of years ago, our professional standards setter said, hey, you need to share this with the board as well. You need to let them know what you're looking at. You need to let them know why you're looking at it. So you can see that we have a bulleted list here of things that we consider to be significant risks and where we're going to spend our time. So the first is the capital assets related to the bond project. As you can imagine, this is a big area for the library. It's not something that's always done in the ordinary course of business. It's something the public and the board are very interested in. So of course, we're going to spend some time here. There was a new professional standard GASB implementation this year, and it had to do with software. So what our standard setter, I'm just going to try to very briefly explain this. What the GASB decided is that when you have contracts with software or information technology contracts, nobody's really aware of the actual impact that has on the district or the library, same district, but it's all kind of buried in the notes. We might say, well, you've entered into an arrangement with a software contract for the next 5 years that's going to cost $1 million, and that's in the notes. And the GASB is saying, well, $1 million, that's a lot of money. That should be something that's called out on the statements. And so the new requirement was, hey, we're going to record an asset because you are, instead of buying your own software, you're accessing somebody else's software and you're getting all the use of that. But there's also this obligation that you have to pay this $1 million over the next 5 years. So instead of putting it in the notes, that obligation, they really want to call it out front and center. And if you can imagine, the library is extremely software heavy, lots of technology going on. And so this was a really heavy lift this year for the library and the contract CPA that they worked with to kind of get this standard implemented. Some districts in Oregon, it didn't have any impact on, but we knew going in that the library is going to have a huge impact on them. And so it did. And so of course we identified that as an area we're going to spend a lot of time in. And then the third area is just that fair value accounting for investments. Because of the bond project, some of the money related to that has not been spent yet is being invested. And the standard is that has to be stated at fair value. So instead of just what you bought it for, and instead of what, if I've got $10 in a bank account, I've got $10 in a bank account, that's quite easy. We have to go through and assess the fair value of that and report it at that. So those are the 3 areas that we spent the most time on. And I am going to pause here and see if anybody has any questions or concerns about that. Awesome. Okay.
Brenda?
Yes.
You did have.
Well, that's awesome too. What's the question? Sorry.
GASB standard 96. Does that mean there has to be a line item for every software contract?
There's one line item for all of them. So if you go to the report, let me go back there and we can try to find it. So if you go to page 14 of your report, I think that it's being reported in capital assets as a capital asset. So you'll see that there. Where you will see the detail of that is going to be in the notes to the financial statements.
14?
I'm sorry, I'm looking for it and I'll give you a page number. So oftentimes there's just so many numbers on a financial statement that it's in one line and then we break it out further into the disclosures. That's usually how they handle it, rather than having that statement get so large.
So two places you could find it would be the balance sheet to the statement of net position and the statement of net position. Probably most clearly stated on that balance sheet on page 17 of the report.
Yeah, and if you go to page 33, you'll actually see it called out all by itself.
Yeah, yeah.
So on page 33 is a big table that represents all of the capital assets of the library. And so you will see on page 33, kind of toward the bottom in bold, a caption called subscription-based information technology arrangement assets. And so that's where you have that number of 476,916. And then you have a related obligation to that to balance out that balance sheet. The interesting thing about that number is it's one line, one number, looks fairly innocuous. I can tell you so much work went into that. Many, what in the 50s and the hundreds, I can't remember how many software contracts had to be analyzed because they didn't all qualify. So you have to look at everything to know whether it qualifies or not. And so what you're seeing here on page 33 is that breakdown of the ones that did qualify. And so you have about $476,000 worth of value of software contracts with a related obligation. And so the biggest, I think it will continue to be an area of a lot of effort for the library as new arrangements come into play. But it probably will never be as bad as it was this year, the very first year, where you literally have to identify all the contracts first, then read all of the contracts second, and then run them through a really long governmental accounting standards board standard to determine whether they meet the criteria to be reported in this manner.
Because as you might expect, with any GASB regulation, there's lots of details in as it's written to say what needs to qualify and what can be set aside as something that is either too small or limited in these very particular kinds of constraints that they don't be considered. We looked at all of them for the first year this year. Going forward, we'll look at the new ones or the ones that were new and go through that process. So it's much more limited in scope of what we're looking at.
Yeah. Yeah.
If these are multi-year contracts, you have to take out exactly what's in this fiscal year and carry it forward the rest, even though you pay for it in this fiscal year.
Right. So if some of them are, yeah. So what they do is they have a concept called net present value. And they're saying, if you have to pay $100,000 a year for the next 5 years, you have to discount that and say, well, some of that's probably interest, but the value of that comes back. And regardless of when you pay it, so maybe you pay it all up front. Maybe you pay $500,000 today for the next 5 years. Sometimes that happens. It's more often that you pay $100,000 for the next 5 years, but you bring that whole $500,000 that you're going to pay in the future back into the present today as of June 30th and say, that's my asset and my obligation. And that is how the GASB says they want to call it out. The real value in their eyes is calling it out on the liability section, saying there's an obligation out here, rather than putting in the notes. But then you do have a related asset because it's as if you have purchased the right to use this software for 5 years. They can't take it away. Now, there's a lot of different criteria. If it turns out that there's a 5-year contract, but the vendor can take it away from you, then it doesn't qualify. So when Robert was talking about all the qualifications, that would be one of them. If you've got the non-cancelable right for the next 5 years, no matter what, to be able to access this, the GASB says it's an asset and a liability, as if you purchased it over time. If you can't, and they could take that away from you, Or if you could just cancel whenever you want and they can too, then it wouldn't fall within scope. So a lot went into that number. And it is definitely an attempt on the GASB to make sure that obligations are on the balance sheet and fully understood by the users. Does that help?
That's a heck of a lot of work.
It is so much work. It is. And like I said, some districts in Oregon, some of the municipalities are more heavily technology, and the library happens to be one of them.
I can share with you, I attended this year's Government Finance Officers Association, and the session regarding this GASB was the only session of the entire week that was standing room only. They were turning people away from the doors, and question and answer time went over by about a half hour, and finally they just had to be like, we got another group coming in, I'm sorry, we just gotta leave. There are districts and other public entities across the country that are each this year having this same conversation around this time with their boards and governing bodies, saying, yeah, it was a lot of work and we think we got it, but you know, we're learning as we go.
Yep, it was a big deal, and like I said, a pretty heavy lift. So
Is the idea here to prevent fraud or what?
no, the idea here is to make sure that things that the library has obligated itself to do are not buried in the notes. So
Yeah.
if you enter into a 5-year agreement that's non-cancelable to purchase, to access software, it used to be that we would put one little sentence in the footnotes, which the footnotes are 20 pages long, right? Lots of words. And we would say, oh yeah, the library is gonna have to pay $500,000 to the software contractor over the next 5 years. So not a fraud perspective, it's a perspective of, hey, I think people wanna know there's an obligation like that, and they wanna see it on the financial statement, because if we're analyzing statements, we spend probably 80% of our time on the statement itself and not so much in the notes. So the GASB is trying to get away from numbers being in the notes and that just being supplemental, but everything being on the statements that you need to know to assess the financial condition of the entity.
Okay, right.
Any other questions? All right. Okay, so that takes us on to the next part of the letter. Significant accounting policies of the library are in note 1 to the financial statements. We look at those policies and ensure that they're in accordance with GAAP. We would let you know if they weren't. The significant accounting estimates continue to be the proportionate share of the net pension obligation at PERS. It's your little piece of the pie that PERS owes future retirees, and unrealized gains and losses on investments. You might be surprised that what we just talked about, GASB 96, is not on here. It's really less of an estimate. It really is capturing the actual payments you're going to make eventually. So even though it's a big deal and a heavy lift, we're not considering it like a sensitive estimate. On to the next page. Again, the disclosures, probably the most sensitive to most Oregon districts, are really those PERS pension obligations. They're of interest to boards, to management, and to the public. So it's something that we like to call out. No significant unusual transactions. We didn't identify any actual or suspected fraud during our audit. And then the next is that we did have some corrected misstatements that we found during the year. We had, and we'll talk about this a little bit more too. I have another letter, so I will pause when I'm done talking about it, but then we'll talk about it a little bit more. There's some things that we had a beginning fund balance difference related to last year's fair value adjustment. There was a grant received that we had to call deferred revenue. So I can't remember, Robert might have to refresh my memory on this grant, but it was a grant that they gave you the cash up front, but until you actually spend it and meet the requirements, it's really just a balance sheet item. It doesn't get recognized into revenue. We found a really small amount of some advertising expenses that were included in Fund 400. And what we did when we saw those is we just reached out to Robert and said, hey, we're not experts. Let's run this by bond counsel. There's certain things that can't be paid for out of a bond fund. And this happened to be one of them. It was very small, you can see, but we did, management did move that out. The software-based information technology you'll see here is abbreviated as SPIDA. We did some adjustments related to that. That is not surprising or unexpected in the first year of such a huge GASB implementation. So there were some errors that were corrected for that. And then we also had some error corrections between capital outlay, land, and those were really, again, not unexpected with the level of activity that's going on in the bond project and making sure that we account for those in the right buckets. Is it construction in process? Is it land? Has it been placed in service? Those are the kinds of things that are listed there. And then, you know, there's some earnest money and deposits. Is that placed in service, or should it be an earnest money? So a lot of these things that you're looking at are very much, how does GAAP want us to classify them on the face of the statement, not that they weren't accounted for originally, if that makes sense. So those are just some of the things that we went through. And then related to these, because some of them are on the larger end, what we would consider material, we did have identify some weaknesses in internal controls that we'll talk about in the next letter. So whenever you have adjustments in this, of those amounts, then we have to talk about whether we could do some things to strengthen those controls to avoid those errors in the future. We'll talk about that a little bit later. No disagreements with management. Our audit report was within professional standards. There was no change to it. Again, I've mentioned this, that the library does employ an external CPA firm to help with their accounting and reporting obligations, also just to do some more of that internal control piece. So it's been a really good practice. It's been in place ever since I've been working with the district, just a really way to strengthen those controls. We've talked about other information included in the annual reports, and that's it for this letter. So I will pause to see if anybody has any questions. If you have questions on the adjustment, that's great, but probably we'll answer a lot of them in the next letter.
Ray has a question.
In terms of, it sounds like the misstatements are only a matter of interpretation of where the monies should be going, itemized.
Many of them.
Is this something that our external CPA should have been aware of or should be aware of and didn't catch, or what?
Yeah, and we're going to talk about that, because part of what we do when we have these adjustments is try to dive in and say, okay, what's the context? What's the cause, right? And so jumping ahead to my letter, because I want to address it as the question's asked, we all met and talked about this, and it really came to everybody's attention that the cause of these, the context, is that the library's trying to close their books too soon. You know, we're trying to hit this November meeting. We've traditionally always been able to hit this November meeting, but in order to do that, you have to close your books by about the 1st of September and then coordinate with the CPA so that they can have some review and then get it to us. And that works great when we don't have a GASB 96 implementation, when we don't have a significant bond project going on with a lot of arms and legs. And so we really sat down and said, it's really no fault of anybody. It is really this concept of we're rushing. We're not able to catch it all in the timeline that we have, and we need more time. So Robert needs more time to close his end, and then Robert and the CPA firm need more time to go through all of these things that have to be adjusted. Because you will notice that most of those adjustments are on those full, what we call full accrual statements. The budgetary statements, those ones that you're kind of used to looking at every month, those are closed pretty well and not too hard to close. It's when we get to these, full accrual adjustments that needs more time. And you just didn't used to have this this breadth of adjustments to make. There were one or two. There were some purchases of a truck, let's say, maybe there was some landscaping. Those things are pretty easy to run through. But when you've got things like the new leasing standard that was implemented last year, the new software standard implemented this year, and then just so much activity in building projects, closing by September is unrealistic. And so it was really an aha moment for Robert. And he mentioned it in our meeting, and it just really rang true for me. I thought, I don't know how you're doing this. So that's kind of the context behind all of this. And I don't want to, be a spoiler alert, Robert, but I know he's going to talk a little bit later about our new plan too, because it really isn't a matter of not having, the Marina is a really good firm. They understand these, I look at their work papers, they're doing a really good job. It is a question of, do they have time to really sort through these really complex issues? And I just think that we decided, and I agree, that answer is just no. Someday, maybe, when the bond project is closed, and maybe if GASB stops putting out, a fire hose of new standards, we can go back to these, quick closes. But, at this time, that just doesn't seem very realistic. So sorry, I know you were going to talk about this, Robert, but I definitely wanted to weigh in on it.
It's a great segue into it.
I'm wondering, what is this adjustment for error in capital outlay and construction in progress?
I can speak to that if you like, Brenda.
Yeah, that'd be great.
That's that 672,000 amount.
Was it just placed in the wrong place?
That's basically it. So to give a little bit of detail to it,
Yeah.
I believe all of it was related to deposits paid on items that were going to be placed in service at Lapine and Sisters.
Wow.
And so if you think about the timing of it, we placed those deposits towards the end of last fiscal year, didn't place it into service until this fiscal year.
Okay.
And the issue was that it was showing up as a fixed asset in our possession last fiscal year, when in fact we didn't have it yet, and we hadn't placed it in service yet.
Yeah.
And so it was that disconnect. We were tracking it as, oh yeah, this is definitely something we prepaid for, but it was still showing up on our asset amount. So it was showing up in the balance sheet as something that had value. If we had to sell it today, we could. And of course, that wasn't the case, right? Not until this fiscal year. And so that was what that's related to. That's also what the earnest money deposits are related to, the 700,000 capital outlay and land, by the way. That's for the land at the location for the new library on the east side of Bend. So that one is a payment of earnest money on land that we have not yet finalized of the purchase on. And so technically it shouldn't be on our asset register as a positive value asset, right? It's not something that the library holds as an asset today or as like June 30th. So that's what that one is.
So where is it placed?
Well, what you do is you hold on to it as it's prepaid towards the asset, but you don't book it in the asset register. It doesn't actually show up in that section of the balance sheet in an asset. It shows up in the balance of amount in your prepaid expenditures, because prepaid expenditures are also a kind of asset, right? It's
Right.
something that you've already paid for, but you haven't expended
Yeah.
Yeah.
Good, thank you.
Yeah, this is all very related to classification.
Yeah.
And as auditors, of course, we have to look at that and have to report on that and give an opinion. The reality is, though, they were all assets on the balance sheet somewhere. So
Right.
we weren't missing assets. We were just trying to get them classified appropriately.
One last thing, the adjust for error in capital outlay and loss on disposal.
So that, I think that, and Brenda, correct me if I'm wrong, I think that one is essentially a second description of that same $700,000. So like. it
It's
just came-
very related. I think it's the other side, but that has to do with disposing of all of the costs related to the initial purchase for the initial library, I believe, the main library, correct, Robert? It was, we were,
I don't think so, just that
okay,
that's
I could be wrong.
$1,000 amount, that flat 700,000 is the only place that really came up in our discussions this year.
Yeah,
was
I think
related-
I think that we had to reverse it out twice is what happened. So it may have been on the conversion from the budgetary statements to the other on there twice, because we did have to wipe it out twice, but you're right. I think it was only one transaction.
Yeah, but I think you're right that this is the one that we had to identify 2 different times. We had to
Mhm.
back it
So it
out.
actually wasn't a loss.
Well, I mean, in terms of the way it's categorized, yes, it was not a loss.
We didn't actually
No.
lose $700,000.
No.
No,
That's what we-
again, that's really just an accounting way that we have to account for that, but no. So,
Yeah.
We'll all speak English one day.
Not accountants.
Okay, thank you.
okay, well, we've really talked about everything, most everything in my next letter, but we'll go through it because I want to make sure we don't miss anything. These are those identified internal control deficiencies that we talk about when we have to propose adjustments for management. So when we go in and we say, oh, this doesn't quite match what we believe how it should be accounted for, or what we're seeing in the evidence, and we get together and we say, oh yeah, you're right, we need to get that fixed. So there were that number 1 here at the very bottom. One of those was some errors in that GASB 96 implementation. One of them was that instead of using the annual amount, a monthly amount was used. And then that's a pretty easy, literally missing a 0, honestly, because it was, I can't remember, but it was literally missing a 0. And then also there was one contract that we found and identified that didn't get pulled into the scope. So these are very, I expect I'm going to be sitting in front of a lot of people talking about this. It's just a really hard standard to implement. And so again, when I'm talking about that time-based, the question is, and I think the answer is that if you have a couple more weeks to really go through those with a fine-tooth comb, this kind of thing gets found before it comes to the auditors. So that's where we're talking about, I think that you need more time with some of these really difficult to account for balances. The same thing with the number 2. It's just some of those errors in classification and what really happened. If the CPA firm has time to really go through in detail, none of those would have come to us either. As I said, they're a very reputable firm, really well known, and they know their GASBs. It's a time thing. So that's sort of where we landed. And then number 3 is the same thing. That really is a time thing, because there was something that was adjusted and they saw it right when we called it out, and it was just a timing thing. We happened to see it before they did. And it has a lot to do with the way that they have to wait until Robert's done, and then they have to try to get their part of it done. And if they don't have sufficient time to get that done before it comes to us, there's a lot of things that can slip. And so it's just not a matter of expertise. It's really a matter of, do they have the time to do the job that they've been engaged to do? And does Robert have the time to bring up questions he might have, right? He might have booked something and go, oh, I need to ask about that, but no time. So that's really what we're seeing. And I feel really good about, I know that if this, Robert's going to talk a little bit more, it is required that a plan of action be submitted to Secretary of State. I personally feel really good about the plan of action because I do think more time is needed to close this, the books before audit.
And so this will improve next year, then, this time problem?
Yeah, again, to kind of give us a little preview for the memo that I'll present to the board in just a sec. What I did in consultation with Brenda and Sensiba team, as well as our third-party accountants at Marina, was put together a proposed schedule for next year that aimed for presentation of this report and letters from the auditor in the December board meeting. And what that does is that gives us 2 to 3 additional weeks of internal review between us and the accountant. And it actually allows for a little bit more time for the auditor to spend time too and ask questions, because some of what is helpful is that back and forth and providing enough space for that to happen so that we're not. We also want to make sure that we're not rushing through any segment of the process. So yeah, so we basically, we think we have a schedule that gives us a bit more time for our reviews and also allows for us to still be able to present this to the board in a reasonable amount of time before we close the calendar year, and not too far out from the end of the fiscal year. Do you have any other questions for Brenda?
Well, just, how do you determine the fair value?
Because the library doesn't invest in anything, wild. It's usually bonds, security bonds, maybe municipal bonds. And so there's usually a readily determined fair value there that you get from the investment firm. You can sometimes, I don't think, Robert, you can correct me if I'm wrong, I don't think you have any equity securities. I don't remember, but usually there's a readily available market value out there that you can find. And for any of the debt securities that the library is invested in, the investment brokers give a value for that. And we generally rely on that.
The rough answer for the debt securities, the bond investments, is that if we were to turn around today and go out into the bond market with the investments we are holding, what could we receive for it? And that is really tightly correlated to the bond yield in the current market. So it's from the standpoint of would we do it versus what we need to report as far as financial accountability, the fair market value reflects that the value of if we had taken all of our investments, including our LGIP account, and kind of quote unquote cashed it out on the end of the fiscal year, what would that value be for all of those holdings? In actual practice, of course, we're holding those to maturity. LGIP, we're holding that until we're pulling cash as needed, and then those investments really don't get realized as a gain or a loss for the district.
So why would there be an adjustment to that? Because the market value on any given day for all of our investments is pretty well known.
Well, it's the difference between what the library paid for it whenever they did and what they could get for it today.
That's the adjustment.
Yep, that's the adjustment. And unfortunately, and also one of the reasons that we put it in here as a sensitive estimate is, that can be quite volatile. If something happens to the bond market on June 30th, plus or minus, that can be quite volatile. And it might not have anything to do with the intent of the library. Eventually they will get, what they get for it when it matures, but it is really it's almost a liquidation value. It's the GASB saying, what would happen if you had to liquidate this right now? What's going on, what's in the market? Because they don't really let us even look at, is there an intent to hold? They used to let us look at that years ago. You could look and see if there was an intent to hold. You didn't have to adjust the fair value. Within the last 5 years or so, I don't know if it was 5 years, time goes by so fast, but they've changed that. And they've said, look, we can't, you can't estimate that way because every management estimates differently. We're just gonna have one hard and fast rule that everybody's measured by, and that's fair value.
But setting a standard baseline in time for all your assets, all your investments.
Yeah,
Then you compare that to next year's.
yeah.
If you want.
Yeah, and so if on June 30th of a certain day, things look really dire, you could lose $1 million in June 30th, and if by July 10th they're better, next year you're gonna have a big income amount. So like I said, it's quite volatile. It could be a loss this year and a gain next year, and none of that really may ever transpire when you actually go to sell it. So it's what they decided was the best way to report, so that everybody's reporting apples and apples.
Okay, thank you.
Thank you so much, Brenda.
You're very welcome.
We have no action needed on that.
No action needed for that one. That one is a monitoring. Of course, if there are additional questions after this that you would like me to address or to pass on to Brenda as a direct question to the auditor, that's always a possibility.
And you all have my email address. You're always welcome to directly contact me. Let me know. But if there's no questions, then I will probably just excuse myself and let everybody take over with the rest of the business.
Well, thank you again.
Yeah.
Thank you.
Thanks for having me. Bye.
So the next is the corrective action plan for audit findings.
Cynthia, has a question?
Cynthia,
I
yeah.
had a question.
Oh,
So
sorry.
in the report on page, this is just because
Mhm.
I want to understand.
Yeah.
On page 34,
Yes.
she talks about an office building lease and a commercial building lease.
Okay, so office building lease is the, we have a few actually this last fiscal year. So we have the library at East Bend
Right.
at Borden Corners.
Mhm.
And we also have the temporary location at the Redmond Design Center.
Oh, okay,
Mhm.
all right. I
Yeah,
understand.
And in fact, there is even a small amount for the period of time that we leased space from the Pine Park and Recreation.
Okay. I was, when I read that, I thought, I think we can
Yeah,
be spent,
yeah.
I didn't think
It's-
about the
it's-
temporary space.
And it can, and the way that it's worded too can kind of like catch you, because it's technically, from our perspective, we're not leasing office space,
Right.
right? We're leasing library space
Right,
from
right.
the standpoint of the report, it's office building.
And I don't want to take too much time, but I wanted to, on page 37, she's got there's a graph there on future maturities of the long-term debt as follows. Can you just real briefly explain that to me?
That one's 37, you said?
Yeah, number 37.
Okay, so let's see, that is related to note 6 on long-term debt. And it is essentially, whenever we report on the bond related debt that we incurred from the bond measure,
Right.
not only do we talk about what are our upcoming payments and what's due within a year, but we also have to report on what are the payments going out into the future that essentially pay off the debt.
Right.
So this table that's on the top of 37 is essentially a breakdown year by year for the next 5 years, what the principal and interest payments the district will make. And then for the sake of brevity and just long-term projections, then it groups it in 5-year chunks, it looks like, going further out. So 1 year payments for 24, 25, 26, 27, 28, and then the next 5 years from 29 to 33, and so on until the entire bond measure debt is paid off.
So it's just paying off. Okay, got it.
Yeah.
All right, thank
Yeah.
you.
Okay.
Any other questions? Okay,
All right. Okay, I would like to present the related memorandum. As Brenda mentioned, whenever there is a material weakness identified from the auditor, we're required by the state to put together a plan of action as a district of how we want to address those internal control deficiencies. So that's what this memorandum is taking us through. And then it does have on the memo a recommended motion if you agree with the findings. The memo itself lists deficiencies. These are the same word for word right out of the report that Brenda just took you through. So it's essentially a restatement. And then in terms of the plan of action, it does refer back to the second page, which is Appendix A. This one, if the board decides to adopt this plan of action, then our board president would sign it, and then I would file it with Secretary of State as our corrective action plan. So if you look at the bottom of Appendix A, there are 3 distinct elements that I'm proposing for our plan of action to address deficiencies. 1, the district will perform a more thorough quarterly review of capital assets, SBITA, which is that new GASB standard of subscription-based IT arrangements, and investments with the contract CPA to better prepare for audit. So the intent of this first one is we're trying to tackle the root cause of sufficient time for review 2 ways. One is to propose more time in the audit process at the end of the year, and that review of year-end things. The other one is to try and catch more early on, that at the very least, there are things that we can only do as an annual, because it needs to be kind of gathered up into an annual evaluation. But there are things that we can estimate. There are items that we can highlight and say, let's keep an eye on that, and then annotate it. And we already do a quarterly review with the contract CPA. This is flagging these specific risk items that Brenda talked you through to say, okay, these are on the checklist for the quarterly. We're not going to wait until annual to really tackle these. Second one is performing a more substantial review of the trial balance on financial statements with the contract CPA before presenting them to the auditors for review. So that is part of that element of allowing for more time for that annual review before we've certified that everything is good for the auditors to start laying eyes on it. And then the third one is that the district will present the audit report and annual financial statement at the December board meeting, starting with this current fiscal year when we do the audit for that. So again, that's tied to additional time. Do you have any questions about those or anything that I can address?
Doing a quarterly review on the investments, what was that topic? Because you have to do the fair market value on July 1st?
That's true. So the fair market value adjustment will need to be an annual review item. But there are other elements of the investment portfolio that make sense to look at quarterly. Sales, gains, losses, things like that. New purchases, actual transactions. It is actually tied to the investment policy that the board adopted a couple months ago, and the quarterly investment report that I'm preparing for you, and I'll present the first one today. So it's folding that into the overall quarterly review process as well.
But that wasn't a deficiency or mistake.
Yeah, the really looking at those new investments, sale of existing investments, and gains and losses are all part of that fair market value. It's showing up in a different part of it.
Okay.
Yeah.
And in this plan of action, there will be enough time for auditors to go over everything and have it done in the appropriate time frame that the law allows.
Yes. Yeah, and in fact, ahead of presenting this memo, I did get just a like I said, that rough schedule, proposed schedule out to the auditor. Brenda reviewed it and said, this all looks reasonable. We made one tweak of the week that they would show up, but it had more to do with deconflicting her other accounts so that she's providing enough time for all of her clients and not just us. But yeah, it should provide sufficient time for the auditor review as well for proper accountability.
Okay. Any questions on Robert's corrective action plan? Further questions?
No, it's good.
Yeah.
Okay, so there is a recommended motion language, which you're welcome to use, or your own language as well.
Do I have a motion?
I move to adopt the recommended plan of action to address control deficiencies identified during the audit of the fiscal year ended June 30th, 2023, and that a copy of that plan be filed with the Oregon's Secretary of State in compliance with ORS 297.466.
I'll tell you.
All those in favor? Aye. Motion carries.
Place that on your desk for signature. Yep.
Oh, I've got it.
But you've got a copy as well?
Oh, I have the same thing.
Okay. Okay. In case you hadn't had your fill of financial statements, it's also that time of year for quarterly financial reports.
We've got a monitor report.
Oh, sorry,
That's right.
very sorry.
I flipped a coin and
Yeah.
decided this one might be you first.
Yeah.
Are you ready for that one? Funny?
Yes, next item is financial conditions and activities. Is that what you're talking about?
Yes.
Okay.
Okay, to keep this short, because hopefully you had a chance to read it, the only significant case that's different this year is policy number 9, which is I will not acquire, encumber, or dispose of real property without prior board approval. And in this past 12 months, that was the Redmond Park property that the board approved purchase of in August. Otherwise, everything else is fairly standard, and I'll open up to any questions.
Nope.
No further questions? Let's see, do I have a motion on financial conditions and activities?
I move that the library is in compliance with the fiscal conditions and the activities policy.
I'll second.
Okay, all those in favor? Motion carries. Thank you, Tom. Back to you.
All right. Yes, so it is that time of year for the first quarter financial report. I'm gonna spend a little bit of time on some of the newer sections, but it's my hope that I will still give sufficient time for review of the existing parts of the report that you're used to as well. So if you have any questions, I'll kind of stop when we get through our typical quarterly, and then we'll move ahead with the additions. All right. So as usual, the first page covers our cash reconciliation report. So this really is kind of the modified cash position that the district is holding. Not too much to mention about this. The numbers are all fairly consistent with what I was expecting. If you look at it compared to last quarter, it does reflect a decrease in the overall modified accrual fund balance. However, that's consistent with two key things that happened in Q4. That happened in Q1 relative to Q4. One is the construction projects continuing apace, so there's cash outflows related to that. And then the second one is that there's always some fairly large purchases that happen at the beginning of the fiscal year for things like annual software renewals and other things. So we did see outflows on both of those fronts, and that's why you see a reflection of a decrease from last quarter on the modified accrual fund balance. And we'll talk about this in 3 months, but the anticipation, at least, is in the Q2 report, we'll actually see a net increase in our cash holdings, and that will be because November is typically the month where many of the tax receipts really start flowing into the district. Let's see. So now this next one is our highlights of the detail pages that follow. So if you want to kind of do it side by side, you can jump to the general fund statement here that shows resources and expenditures. And again, as a reminder, so our first column for all of these back reports are what was adopted in the budget for the fiscal year. The second column shows actuals as of September 30th. So it goes all the way through to the end of the quarter, but doesn't reflect anything that happened after. And then there's variances over and under, which can be useful if you see something, unexpectedly higher or lower. But really, the place that I like to focus a lot in terms of identifying places for further scrutiny is that percent of budget received. If all things are equal and you're a quarter of the way through the fiscal year, like we're reporting on here, you might expect that straight line, everything should look like 25%. So then you start asking yourself, okay, if I have variations that are well above or well below 25%, do I understand why each of those is the case? And if you do, great. And if you don't, that warrants further investigation. So when we look at our general fund, and we see that total resources line, we see it says 51%, which is relatively surprising, especially since I just told you that most of our tax receipts don't come in until Q2. But if you look at the breakdown of what's causing those to trend higher than an expected 25%, well, we had a fund balance, our actual fund balance to start the fiscal year was about $1 million higher than what we anticipated in the budget that we prepared back in March and April and adopted in May. So there's always a little bit of educated guesswork in figuring out where are we going to land at the end of the fiscal year and what are we going to carry forward. So in this case, we were conservative on that fund balance and the actual came in a bit higher. That contributes to that overall resources because we had more cash to start with. We had more money in the fund. The other place where we see it is, I'm going to say this again this year too, because even though we adjusted our budgeted anticipated interest rate of return on all of our holdings, interest rates are still trending higher and holding higher. So, in relative to the budget, our interest earned on this account was higher already. So 25% of the way through the year, we've already made 41% of the anticipated budgeted interest, and I expect that we will exceed the annual budget amount for that interest revenue. Also, there are a few revenue streams that do end up coming in early in the year. So we contract with Jefferson Cook County for ILS. We have a memorandum of understanding with the law library, with the county for the law library, and both of those show up as revenue in Q1 because of that, and so they're already showing up at 100%, 82%. Okay, expenditures. So there's two parts to expenditures for the general fund. We have personal services, so that is essentially salaries and benefits. That's coming in at around 22% as of September 30th, which is tracking pretty well to where we thought we would be budgeted. No areas for concern there. In terms of materials and services, the other big component of expenditures, that's tracking overall to 24%. So overall, again, tracking fairly well to expectation. And then we peel another layer of the onion back and we start looking at the individual elements that make up those materials and services and ask, okay, are there any of those that are running higher or lower than where we would expect it to be? So auditing is running higher. In fact, auditing exceeds what was budgeted. So we are going to need to apply a certain amount of the unanticipated materials and services to that particular budget line item. Why did it run higher? Well, first of all, it ran higher than 25% because the audit occurs in the first quarter, right? So most of the audit related payments are landing as expenditures in Q1 or Q2. It's also higher than was budgeted because much as I tried to, again, anticipate from last year, how much more am I going to need to allocate for this year's audit? It seems I didn't quite hit the mark. So again, the complexity of these audits continues to be incurring higher expenditures than we were anticipating. So I would expect next year's budget, when I put a proposal in front of Todd and brings it to the board as part of the overall budget, that I'll ask for something a bit higher in that audit category just to cover these, because as Brenda says, we're asking for more time, we're allocating more attention because it's gotten more complicated with new GASB rules and just with the construction project continuing on.
So Robert, is that mostly your and our staff time, or is that also mostly CPA time?
Oh, that's basically billing from either the CPA or the auditor.
Or the other,
Yeah.
external?
Yeah, exactly. And for the CPA, they break out what hours they're billing related to the audit versus what hours they're billing related to our ongoing accounting support. Yeah. Let's see, other areas. Well, software, that's expected because, as I mentioned before, we have several software licenses that annually renew, and so they expend in that first quarter. So that's running high for that reason. Refund adjustments it's a very small budget line item. So $350, and we've spent $300 of that. Some years we spend like $25 of that. So it really varies with annual needs, and it's not a major concern. The percentage is high, but the dollar value variance is not excessive. And then I always include this disclaimer. It seems most excessive in Q1 when you look at that rent and you go, wait a minute, why is rent at 33% when it should be 25%? Like, that's a known value. Just as a reminder, we always pay for the next month at the end of the current month. So really in Q1, it's reflective of 4 months worth of rent, right? It includes the October rent payment. In terms of expenditures that were lower than 25%, all of those were really variable, the kinds of things that go up and down relative to district needs. And so typically, like, we allocate a certain amount based on what we anticipate, but then it might come in a little bit higher, a little bit lower as we go. So things like legal services, recruitment, supply budget, volunteer and staff recognition, those things will vary as we go through the year. And then finally, we've got the category of capital outlay. This one, total capital contingency is 14%. But remember, that also includes contingency. So really, I don't look at that bottom line number for total capital and contingency. I look at capital outlay and I say, oh, okay, we budgeted for X amount of capital outlay. We're a quarter of the way through the fiscal year and we've spent about 21% of that. Okay, that seems reasonable. What does that relate to though? Because when we're talking about capital outlay, that is purchase of assets for the district. So I want to know, what did we purchase in this last quarter? With respect to capital outlay, the two biggest contributors to that budget are coming either out of facilities, which is my department, or IT, Mark Hovey's department. So it's relatively easy to drill down into what did we buy. For facilities, that capital outlay, for the most part, relates to the repairs that we made to the administration building that will represent ongoing capital improvements to the building. Things like where we had to replace some of the old siding on one area that had gotten extremely weathered. And invested money into extending the life of that building, the quality of that building. IT, those were all planned purchases with computers and equipment. And so again, as far as Mark's purchases go, they run fairly regular cycles. They do go through variability based on needs, but in general, we cycle in new machines to replace things that have gone obsolete or are no longer supported. Okay, so that's the general fund. We look at the next one of the numerical reports, the reserve fund. This one is fairly straightforward, so we'll just talk a little bit about this one. As far as resources, again, coming in high at 97% relative to where we are in the fiscal year, almost entirely due to two factors. No, entirely due to two factors, actually, because this one's such a simple fund. The first one is that, again, the beginning fund balance, that one's sitting kind of where we expect it to be. So like, that means we hit the mark, but as far as a percentage goes, 100% means that it's 100%, right? And then other interest revenue, again, it's coming in high. It's 56% of what we budgeted for anticipated interest has already been earned in this fund. And so that kind of aggregates to a 97% of resource on this fund. As far as expenditures go, fairly low expenditures. And the reason for that, we're going to continue to see this be very low relative to what was budgeted, because at the time we developed the budget, we didn't know yet when the district vehicles that we had purchased last fiscal year were going to arrive. So we actually built it into this fiscal year budget, so it was appropriated in case those vehicles that we had already bought arrived, because as we talked about, it's not when you pay the expenditure, it's when you put it into service. So we didn't want it to kind of land on our books in this fiscal year if we hadn't appropriated it. So we've appropriated more than we need under reserve fund. There's no major expenditures planned in reserve fund. The only contributor here is about $8,000 devoted to making some of the upgrades to those vehicles, the wraps on the vehicles, for example, maybe some small equipment purchases for tie downs and other ways to arrange the vehicle. The shade covers that we purchase so that when they do outreach in the summertime, they can actually set up some shade cover for heat protection. Those represent material upgrades so that if we turned around and sold those vehicles down the line, that would contribute to a value in the vehicle and we sell it. All right, grant funds. So grant funds, this one again, resourced higher than one might anticipate. The reminder here is that the foundation typically issues an annual donation to the grant fund at the beginning. So that's a Q1 revenue, and you can see that reflected here in that other grants line. And then the other thing is that, again, fund balance, if you're coming in anywhere close to where you're budgeted, then it's going to sit around 100%, which is going to inflate the percentage relative to your resources. And then our standard culprit, the other interest revenue is coming in high. So we will probably bump that up again next year if the financial conditions warrant it.
So is the other grants, the 37,000, all foundation?
It is, yeah. So the foundation, and it's broken down and earmarked for specific grants within this basket. So grant funds with an S, is the only report that has the S, is because it covers a novel idea. Man, help me out with the name of these, 252.
Youth initiatives.
Youth initiatives and collection development, yes. And then as far as expenditures go, the majority of the expenditures in Q1 were related to a novel idea, as well as the Ready to Read grant for 2022-23. But that money was received last fiscal year, so it doesn't show up on the revenue side. It shows up just as expenditures against that grant. Moving on to the next fund. So this one's the Capital Projects Fund. Beginning fund balance, we came in fairly close to where we anticipated it when we budgeted it. So that's sitting at 99% of resource. Other interest revenue already earned 62% of what we anticipated annually. And again, this is just the interest revenue relative to the LGIP. This is not any investment gains or losses. So both of those combine to resource overall at 98%. As far as expenditures go, we're looking at about 13% expended. And the thing I'll say about that is, again, what we do is because there is some amount of variability in the construction project based on, we develop it based on the budget and where we think the spending will happen. But sometimes a land purchases shifts from 1 month to a different month. Sometimes the construction schedule stretches out. And so what you appropriate may be more than what you actually end up spending because of those things. And that's what we're looking at here.
Was the beginning fund balance 200 million?
Mm-hmm.
Or about 195 million?
But remember, there was a premium as well. So I believe at the start of this fund in 2021, the beginning fund balance was like 224.
Right.
Yeah.
So would that be the budget? Why is it 200 million instead of 224 or 195?
Well, that was that year back in 2021. So each year, as we continue to expend funds for the project, that beginning fund balance will tick down. Next year's beginning fund balance will be lower than
budgeted number.
Even in the budget. So the budgeted number is where we anticipate we'll start this fiscal year.
The year, not the beginning.
Not the beginning of the fund, but the beginning of the year.
Okay.
Yeah.
July 1, 2023.
Okay.
Yeah. So finally, we have the debt service fund, and this is essentially the fund that is set up specifically for the tax assessment that was passed by the bond measure in service of payment of interest and principal on the debt incurred by the bond measurement. And so what we're looking at here is in terms of revenues, fairly low from tax receipts, because again, most of the tax receipts land in Q2. Beginning fund balance, we carried over. We were pretty accurate on that one, which is understandable because there's exactly 2 payments made out of this fund. So, and we know exactly what it'll be years in advance. Yeah, I think the only reason it's off is because we essentially underestimate or overestimated the amount of interest that we thought we were going to get. So anyway, and then you can see in the expenditures, no expenditures have been made because those payments happen in December and in June. So they show up as Q1 and Q4 expenditures. Okay. All right, here's the part where I pause before we roll into the new section of this report. Do you have any questions so far about Q1? Okay. All right, so the next area is something that we're doing for the first time this quarter, but we will carry forward from here on out. And that was as part of the additional controls that the board approved when it adopted a formal investment policy. One of those controls is quarterly report back to the board about the state of our investments. And that's what this represents. Now, even more so than what I just went through, I highly recommend that when you look at it, you read the highlights, the narrative that goes with this just table of numbers to parse it. And what I'd like to do is I'd like to help you decode the table of numbers, and then we can do the highlights, okay? So what does this table represent? This is the page that says quarterly investment report, capital projects portfolio, September 30th, 2023. So it's a table that represents all of the district's holdings of what they invested of the bond earnings or the bond measure money that we raised, okay? So this is just related to the bond fund, and it's just related to the investments that we have as of September 30th. So you'll see that there's actually going to be some that we look at that have since sold, but those won't show up in this report as sold assets. They'll show up as investments that are coming to maturity very soon. So you see it's a table and it's got, I don't know, maybe 24 items. Each of those represents an individual investment. And this was set up with the original bond measure in consultation with Piper Sandler as a series of like almost a ladder of investments. So rather than taking all 224 million and putting it into one thing and then waiting for it to mature and then cashing it out, we recognized that the project was going to be ongoing. And so they helped us to structure a set of investments that would come to maturity that matched fairly well with expectations of cash flow needs, as well as allowed for a recognition that at the time that we passed the bond measure and issued this debt out to investors, the bond yields were super low because the market rate was low, right? And that benefited the district. That's how we were able to get that premium. But when we turned around and tried to invest it, then we would be putting it into a bunch of investment interests that also had low bond yield. And so we structured it so several things came to maturity early so that we were anticipating that the yield was going to rise. And in fact, it did. So when those came to maturity, we were able to turn around and reinvest them into something that had higher rate of return. So what we're looking at now is the kind of the tail end of that cycle. These are the ones that were structured either to mature right around now when we originally set it up with Piper Sandler, or the ones that we reinvested in 2021 and 2022, knowing that we could get a better rate of return when we needed the cash later on in the project. So each of those rows represents one of our investments, and I would highlight for you that the very first row of this table says issuer LGIP capital project account. That's because the money that we hold as cash in LGIP is in a sense an investment because we are part of the local government investment pool. It's almost like a mutual fund for governments, right? It's a money market account for governments where that money is put into a pool, and a state entity is making sure that all of that money in the pool is being invested in a way to maximize rate of return with a high degree of liquidity and stability. So that's part of this investment portfolio, and it has a certain rate of return. How do we know what the rate of return is? Well, I would highlight for you the column that says YTM. So that is the yield to maturity number, and that's essentially giving you a rough idea of what the future value of your money will be at the end if you apply this as an annual interest rate on that money. That's a very crude way of explaining it, and it leaves out a lot of subtlety. It's essentially saying, if I take this $19 million and I leave it alone for 12 months, I should get 4.5% of interest at the end of the year on that, okay? Now, that number in LGIP fluctuates from month to month sometimes when the market is more volatile, like it was last year, or maybe from quarter to quarter, like it seems to be going forward. So right now, actually, the yield that LGIP has reported to us is closer to like about 5%, but it does seem to be slowing down now based on market conditions. Second line here is the uninvested cash. So at certain points, the money that we have in that safekeeping account is too small, essentially, to be turned back around into a reinvestment. It's also, in general, like maybe too small for us to justify wiring it over because there's a certain wire fee for those as well. And so right now, as of the end of Q1, we had about $23,000 of just cash sitting in US Bank, ready to be reinvested when there was an investment that justified that. The remaining lines represent each one of those investments that we have. And so I want to take that third line as just one example, and we'll just kind of parse through the data, but this pattern will repeat for all the rest of the lines. So the par value, so that's essentially how much money was put into the investment. So it's $1 million put into this investment. It was purchased on 5/14/2021, so it's still part of the original series that was invested back at the bond measure and the issue of debt to the market. The investment issuer is US Treasury NB, so that's a US Treasury note. Has a certain coupon value. So coupon value is for US Treasuries every 6 months. It's kind of like if you think about an equity investment, what a dividend is. So in addition to the interest you might make on this, you also get a certain amount of additional money every 6 months for as long as you hold it. So there's 0.13% coupon value on that. And that was really, really low because at the time, the market had really, really low interest rates. And so it's reflective of that. And if you kind of vertically scan down the table, you'll see these numbers start to increase about halfway down the table. Not coincidentally, the settlement dates start to increase about halfway down the table because the interest rates started rising. And so those coupon values on US Treasury notes rose. Maturity date, this one is basically telling you exactly what you think it means. On that date, that investment comes to maturity and it turns into cash and it sits in that cash holding account. And then we get to decide, what do we do with it? Do we take that cash and transfer it out so that it can meet cash flow needs for the bond project? Or do we anticipate that we're not going to need it for 6 months, a year, and can turn around and reinvest it into another bond? Call date. Some investments, US Treasuries tend not to, but some other ones like corporates or even some agencies and other items may have a carve out that says, the issuer might actually choose to pay it early. Again, if you think about it in terms of personal finances, We have some loans we take out where you can prepay early and there's no penalty. And there's some where you have to just service the debt and you stay to the schedule. And if you don't, then you're in trouble. So that call date is basically like, we're on the opposite side, right? We're the ones holding the investment. We're the lender in this case. And the debtor to us in that investment is the US government or the Federal Farm Credit Bank or some corporate holder. They might choose to pay down the debt early, in which case that call date is basically like the early pay date where they can prepay or, early pay it off without any penalty. For us as a bond investor, it just represents a possible risk of, we might not make the full maturity on it. We'll still get fully paid and we won't lose money on the investment. We just might not make as much as we expected if they pay it off early. Number of days is number of days to maturity. YTM we've already talked about, but again, that's that yield to maturity. YTC, I don't remember what that one is. I can look into it if you're curious, but it looks like the only item that carries that is that Federal Farm Credit Bank. Approximate cost. So that's basically the what it cost us to make that investment. So in some cases, it cost a little bit less than the par value. In some cases, it costs a little bit more. Typically, that's tied to prepayment to an existing holder to buy them out. So you don't normally go into the bond market and buy a fresh out of the oven US Treasury note. You're usually buying it in the secondary market from somebody already holding it. Again, I'm going to go to the equity market. It's like most of us don't get stock in a company when they issue an IPO, an initial offering. Most of us, if we invest in the stock market, we're buying a share of Apple or IBM from some other person who bought a share of Apple and IBM. We're not buying it direct from the company. And this is the same thing. So that approximate cost reflects the buyout price of what it costs to buy it from somebody else in the market. And then the price is essentially taking that approximate cost and converting it into a percentage. CUSIP is the actual name on the bond market of the investment. So it's not just any old US Treasury note, it's got a name. And we like to call it 91282 Cap 6. So that's the name of your bond. And then the ratings from the three major credit rating agencies. So basically that helps us in this investment report to know whether our investment portfolio is high risk or low risk. And certainly it helps us to identify whether we are in compliance with your investment policy, or if we're out of compliance and we need to change our investments. And then that estimated net profit at maturity is essentially what it sounds like. This is what we hope to make above and beyond the value of the investment. Again, as you scan further down and further down, you see those numbers increase, and that's a direct reflection of the increased yield. So why is this important in terms of determining whether we're in compliance with the investment portfolio? I'm sorry, the investment policy. So that bottom section of this report has a bunch of roll-up numbers that really get to the heart of it. There's certain things that investment policy, and I would encourage you to look back through your board packet and take a look at it if you want more details. But there's certain things in the investment policy that talk about how much of our investments need to be less than 2 years in maturity or less than a month or a year and a half, because we have certain obligations in order to be able to meet our expenditures and our cash flow. And so that annual aggregate maturity shows, okay, the vast majority of our portfolio is maturing either in the next couple months or sometime in 2024. So we've got the majority of what we've got invested is going to come to maturity relatively soon in terms of meeting current or anticipated cash needs. That compliance matrix kind of breaks it down based on the types of investments. Again, looking in the investment policy and in compliance with Oregon regulated statutes, we have to maintain a certain mix, and there's certain percentage of what might be deemed higher risk investments that we can't invest more than a certain percentage. So in general, the policy states that we can have it all in treasuries, or we can have it all in LGIP. Actually, I mean, we're limited from LGIP of how many dollars we can have, but in terms of a percentage, those two, there's no limit of what you can have. In terms of particular government agencies, again, no limit in what you can do. And you can see in this box that says compliance matrix, there's a couple of acronyms under there for government agencies. These are the ones that are specified by ORS. So FHLB is, I want to say that's the Federal Home Loan Bureau. FFCB is Federal Farm Credit Bank. FHLMC is the Federal, I think that one is Freddie Mac, FHLMC. FNMA is Fannie Mac or Fannie Mae. FAMCA is a farm-related Freddie Mac carve-out. And so you can see, like, these are basically like, these are the governmental or quasi-governmental agencies that are related to issuing large amounts of debt and kind of regulating the bond market. As far as that goes, we can have up to 100% in any of these. But we do tend to invest in the treasuries because they represent a really stable rate of return. You know what you're getting, you know when you're getting it. And there's lots of other buyers out on the market if we did need to turn around and cash it out. In terms of corporates or commercial paper, no more than 35%. And while it's not written here, it's written in the policy, no single issuer above, I want to say 5%. So that if there's, you know, heaven forbid, there's another Lehman Brothers kind of a thing, that we don't have 35% of our holdings in them and then they drop out. We would be exposed at most up to like about 5%. Local and state governments, again, it doesn't say here just because of space, but the policy spells out not just local and state governments, but really for ORS, I believe we're only allowed to invest in a very small number of Western states. And that's because of various state compacts and other understandings of the financial state. But even so, 25% max in local and state as well. And again, that really points to like one never knows the stability. There's much less reliability of state governments because states can't print money like the federal government can. Okay. To wrap this up, the other elements are, what are our minimum rating parameters from the various rating agencies? So you can, if you want to take the time to do it, but I've done this, is you can make sure that every one of the rows here that has a rating is above the rating that's listed in that table for municipals and for CP. Obviously, we don't hold any municipals or CP. CP is commercial paper, so that's corporates. But in terms of like, there were times where we did have a small amount in commercial paper. And so we went through this process of, does it meet or exceed? And then finally, maturity concentrations is what I had mentioned before. When do all these things come to maturity? How far out into the future? Because that represents a different kind of risk. That represents what's called investment risk. If we as a district are holding an investment for a long period of time, we could incur risk that the market shifts in a way that actually, like, it would have been more advantageous for us to turn around and sell them off and buy something new. But of course, if you sell it off, then you incur those, whatever the market value is. And so you could end up, you know, having less return out of that. So that represents an investment risk, basically. So we go through that review and basically we determine whether or not we feel that this investment portfolio meets and is in compliance with the investment portfolio. So then to jump you back to that last page of highlights, this is giving you some highlights of some of the things that happened this quarter. So we talked about the total investment portfolio, par value being at the very bottom of the table. You see that number that's in bold at the bottom of the par value column. That's just a tally, that's a total. So that's 195 million in par value in the investment portfolio. There's a total anticipated rate of return of 10.6 million. I will say that comes with a big caveat, and that is because this portfolio represents money that was generated from public funds through the issuance of tax-free debt. We have a tax obligation if we incur more interest or more gains than we could have gotten through, essentially the initial, the amount that we offered in terms of a bond yield on our bond. And so we contract with our bond counsel every year to do arbitrage analysis. They take a look at it and they tell us where we're situated right now, whether we owe the government taxes in a few years and whether we should set that money aside. Now, Brenda stole a little bit of my thunder. I'm going to steal a little bit of Greg's thunder. We're starting to, in our budget, set money aside so that we are providing enough of a cushion to meet those needs. It is a more conservative estimate than what we probably will owe. But what I will say is, don't count on this 10 million in total. And I know that Greg is not counting on this 10 million in total in terms of additional money that we're going to earn, because there is a portion of this that will be in the budget, but it will be set aside as a line item to say, to be paid to Uncle Sam. Okay. A couple other things to highlight. The transactions that were performed, so you don't see it on this table, and that's why I highlight it, because this is part of my obligation to you through the investment policy. What did we sell? What did we buy? We sold 10 million in Fannie Mae that matured on July 10th in this quarter. We sold another 9 million in US Treasury notes that matured at the end of August and the middle of September. And then we transferred money over from US Bank into LGIP in order to meet our cash needs for upcoming purchases. So no new investments added in this period, but those were the ones that we sold and the monies that we transferred, and it's in that highlight for details. Do you have any questions about this? All right. I promise you, I will not kill you with details every quarter, but I figured this quarter, like, it really was important to take a look at that.
Yeah.
Okay, the final page, and this is super quick. This represents our current investment portfolio of general and reserve funds. It consists of one line, LGIP. So right now, all of the cash that we're holding out of general and reserve funds lives in LGIP. As I mentioned, its YTM, or its yield to maturity, is 4.533% on average over that last quarter. To date, it's sitting in more like 5%. That's great. There is an opportunity here, and that's what I highlight here and talked about when I talked about the investment portfolio. With additional money coming in November through tax receipts, and with the knowledge that the budget that was approved for this current fiscal year has an unappropriated amount of about 16.5 million, that represents an opportunity for us to explore some options for an investment portfolio of limited scope that would mature and do the same kind of structure where things would come to maturity on a regular basis so that it was anticipating our cash flow needs, but could get a better rate of return even than 5% given current market conditions. And so right now, my assessment of this portfolio, the one that's related just to general and reserve funds, is that while it's good and in compliance with liquidity and risk, it is underperforming relative to potential returns. So we could increase rate of return without falling out of compliance with our investment policy on liquidity and risk. It's my assessment. Questions about this one? All right. Okay, that one, there's no decision. It was just a review of the quarterly.
All right. Next is the selection of safekeeping committee.
Yes, I told Todd that the board is going to get tired of me after today. So this last one, and I promise you it's the last one, is very brief. Related to where I left off in the last discussion, taking a look at starting a separate safekeeping account just for general and reserve fund money. Why separate is the first question. Why not US Bank? There are good reasons from both an internal control and just good sensibility in terms of diversification to establish a separate safekeeping account for this money that's related to our general obligations and expenditures, and have that be separated from the bond funds. There's also good reasons from auditing and accounting standard, right? It's much easier. I'm sorry to keep using like examples from other aspects of life, but like when you have a small business, you get a business credit card. You don't put it on your personal credit card. You can, but if you were to be audited, it's a nightmare to untangle. Oh, that was a personal expense. That was a business expense. That was a combined. I need to find the receipt and line out the ones that went. So it's the same thing. It's much cleaner to establish separate accounts for separate piles of money for fund accounting. The 400 fund, the general, the construction fund it's restricted to what it was intended for from passed by the voters. So keeping that as its own account and finding a second safekeeping account makes good sense for a lot of reasons. So as part of our investment policy, we go through a process to identify what's that new safekeeping account going to be? Who does it make sense? As Brenda mentioned, any safekeeping account also needs to comply to various standards established in Oregon statute. So we identified 3 potential domestic U.S. banking institutions to use for safekeeping of investment of general reserve funds. There's Bank of New York, Mellon, and each of these is going to have like a very long name that essentially boils down to the investment arm, the safekeeping account of the investment arm of this very large bank. So it is Bank of New York Mellon, but the actual firm that we would work with is a subsidiary called Pershing. The second one is JP Morgan Chase, but they've got a JP Morgan private bank as its own subsidiary for this type of safekeeping. And then there's Citi Private Bank at Citigroup, same kind of structure. We looked at all 3 of them. And just to cut to the chase, they were all really comparable on all of the measures, except for one. Pershing at Bank of New York Mellon offers 0 transaction fees, which would, at the margins, improve investment rate of return. So in the lack of any other differentiator, it seems to be that Pershing is a sensible choice for the district. And what I'd like to put forth in this memo and ask for a recommended motion would be to create a new safekeeping account. Just like any other bank account, the way that safekeeping accounts are structured, however, are very specific to the larger federal laws about banking controls of holding money and investing money and making sure that there's proper controls and separations. And we went through that process when we were looking at all of these 3 options as well. Questions about that? Okay.
All right, if there's no questions, could we entertain a motion?
I move to create a safekeeping account at Pershing LLC at Bank of New York Mellon for the purposes of investing a portion of the general and reserve funds in compliance with the district's investment policy.
I'll second.
All those in favor?
Do we want to say what portion?
In terms of, I take it as a question for the motion. So in terms of what portion, as far as the investment policy goes, the level of control and accountability that the board has is that I'll come to you every quarter and I'll tell you what we've done with the money. And if you don't like that, you can ask me questions. And if you want me to change that, then that's something that we could look at as a separate motion of the board to say, do this, don't do that. I wouldn't recommend including in the language of the upfront motion. You've already established a policy, and that policy gives the board a level of oversight and control that is appropriate based on Oregon statute.
How about restating that motion, please?
I move to create a safekeeping account at Pershing LLC at Bank of New York Mellon for the purposes of investing a portion of the general and reserve funds in compliance with the district's investment policy.
A second. All in favor? Motion carries. Thank you.
Thank you all.
Thank you.
I'm fine to be here through to the end. I know you got, I didn't know it was guest speakers. I'm good.
Just check in and see if you want to take a break or?
Oh, yeah.
Yeah.
We target a date of January 4th for closing. So we actually may even get Kirby starting a week earlier than we planned, but generally consistent with where we're at on that. So that's moving along really well. The schedule, you know, Sisters in Lapine opened up, as you have seen last month and this month, this past month, and we closed Sun River, opened up the temporary facility, and SunWest was in there as fast as we cleared out everything. They took off and they're running on their new building renovations at that facility. So that's all moving right along in accordance with our schedule. And, you know, when we updated our schedule, we kind of reorganized how we were doing some things at the end, and had some really good conversations with all of our vendors who were doing the shelving and the furniture and the early learning things. This is really helping them to plan and program their manufacturing process. That's ongoing, and purchasing of like all the furniture and things that take time. We have a better runway for them to really get in there, get it made, get it built. Everything's designed. Most of the shop drawings are either done or being reviewed by Miller Hall at this point to allow them to commence that work on Sun River. So we're in a really good position for that. And that even rolls over to the Redmond Library, where we're at the exact same thing there. You know, those same activities are all happening there. Our early learning was scheduled to be finished, and they finished 100% design on our early learning for Redmond. So that's in a budgeting phase right now for final pricing. And you guys will talk about that in December as they finish that up. But relative to the schedule, Redmond is tracking very well. Kirby is making great progress there. Things are moving right along, and it's consistent with their schedule. And they're not seeing any big surprises, no new things from the long lead supply chain issue, which they're always monitoring and talking about, because you never know when something's going to jump up. And so that's been really good. They're doing a really good job of thinking about and getting out there and talking to suppliers and manufacturers to really say, hey, are you going to be able to get this material here to us on time, and with their subs, but going beyond. And so that has been very positive of how they've assessed and planned that aspect. You know, with Stevens Ranch, the other elements that we're looking at right now is plan check. And so our SIMP permit, which is site improvements, we got through second round of plan check comments, and the comments that came back were really administrative in function. Questions about who our inspector is going to be, and put this name of this entity on this plan, and this, not really questions about the engineering aspects. They're saying that's all good. Let's dot the i's, cross the t's, and get some of the stuff. And so our civil engineer said that it looks very promising that by the end of the year, that permit will be fully approved and issued to us, which is really good. Gives plenty of work for Kirby as they start out there and move forward on that. This past week, we actually received our first round of plan check comments on our structural plan check. And I was very pleasantly surprised that I was expecting them next week. And so they came in a week early. It used to always be they'd come in a week or 2 or 3 or 4 late. And so we've seen a nice trend that just really says, you know, the city has been able to improve their performance, their systems, recover from the impacts that they dealt with there with COVID and staffing issues. And so we're seeing some real benefits that our process, plan check process, is performing well and as planned. And kind of as we worked out with the city back in August, they're really hitting those dates. So that's coming along. Miller Hall issued a 75% CD set, and it's a QA/QC, and so it's a set that's circulated between all the design team members to do another round of detailed coordination between the different designs for Kirby to look at them, they're checking their budget, they're looking at constructability issues and giving them comments on. These are the time where they can make final changes to the CDs, because in December, they issue the 95% set, and that's the set that goes into our final plan check set for our full building permit. And we'll use it for purchasing purposes. And you know, you're right there near the end at that point. The 100% set wraps up in January, and that's kind of Miller Hall doing dotting the i's, crossing the t's, and really getting down to the fine details. So our plan production is right on track and on schedule, and so very happy with that. So from a schedule standpoint, that's kind of everything that's going on there. Not seeing any concerns that I'd raise to you guys. I think we're tracking well overall. So in the budget section, I outlined a couple of big elements of the budget and adjustments, and there's a couple small ones in as through the detail. But one of the big ones was, you know, we had been looking at our DSIP, which is our overall general liability policy for the whole bond program. And you know, when we purchased that, we were at the beginning of the project and we had our original schedule. And then as we moved from the Roble site to the Stevens Ranch site, we saw a big shift in our overall schedule. And I talked to Brown & Brown, who's DPL's broker, about that and what's the right timing. And they advised, hey, get in and really figure out, make sure you've gotten far enough into Stevens Ranch and that to know where you're going to be at, because there was no rush on making any adjustment to the policy. And so I've been meeting with them. Generally, we meet quarterly, and we met again here a few months ago and went through the updated schedule that we published in September and told them where we were at and the confidence we had in the current Stevens Ranch schedule, how that affected downtown Bend and the overall schedule. And also how we were now kind of spreading out the work. And so they said, well, it's appropriate now to go with this schedule and budget of where we were at on all of our budget, because the original budget that we gave them was based on the early on as we were just starting the project. And so we've made adjustments throughout life of what is construction costs, what were some actuals now, and what was forecasted now. And so that helped them to go back, and they looked at options with the carrier, and it's a group of carriers that hold the DSIP policy. And they talked to them about, do they extend our current policy or do they issue a separate policy, you know, and at what point? They came back with the recommendation that it be an extension of our current policy. The premiums that were being quoted are based on, okay, here's the risk level of as work is going to be done when we do the extension, and then what's remaining. All the original coverages and terms and limits don't change. It's a 10-year policy that will ride with its extension, where it has an extension, because that's the there's a name for it. It's a term of repose, and I'm missing one word there, but it's that time period for latent defects or latent claims that goes on for a 10-year period. So, and that's built into this policy. So that was a big one. You know, it's an 800 and some thousand. We're finalizing that cost. This was something that we knew about when we did the evaluation of what's going to happen because of the switch from Roble to the Stevens Ranch and the time extension, that there was going to be a premium cost. So we knew it was coming. I will have in December formally to you guys for authorization. I have forecasted the cost in my budget to plan for it. And some of the dollars I had within our soft costs, where the insurance line item resides, I had money still in there in those budgets. So it didn't come 100% out of contingencies, but portions of it came out of contingencies. And it's allocated to each individual work package on a percentage basis of the combined total of the work packages and how much is the individual one. So you'll see those percentages. A big chunk, of course, is borne by Stevens Ranch. It's the biggest one, then Redmond, then downtown Bend, and finally the branches. So that was one of the big changes that occurred. And I tried to lay out how what happened, taking money out of contingency and moving it to soft costs on each of those. The other big one is what we did with the interest earned from the investments and setting that. We've been accumulating it in contingency. And some of it was in reserve contingency, and then some was distributed to the 4 work packages. After we got the arbitrage report, Robert and I looked at it and evaluated and said, wow, it's time to move the money out of contingency into a liability. And so I put it into the finance section, just because it didn't seem like it should be in one of the others. And we called it a tax liability, potential tax liability. So if you look at the budget report, which is attached at the back of the report, on the second page of it, there's interest on bond investments under the funding sources. And it's an $11,442,627 line item. So as a source of funds, that's the interest earned that's coming in. On the budget report on the second page.
Second to last.
Yeah.
Oh, it's that one.
It looks like that without all the handwriting.
Okay.
I think, yes.
Right.
Yeah. And so the last section of this budget report shows you the sources of dollars coming in, right? And that's the line item. That's the 11 million. And so that's all of the interest earned from the investments accounts that Robert went through with you. And that's a forecasted amount based on Piper Sandler's report that goes into Robert that he shares with me. It says, here's what's expected to be earned at the end of these investments. So we have it there in the section above, which is the page before. That's how we spend everything, right? And so it's always been carried in the various contingency line items. The second from the bottom up line item is called reserve contingency. And you can see currently there's a number under total revised budget, which is the second from the left column of numbers of 1,605,000. Well, there was a big chunk sitting there, and then there was pieces in each of the 4 work package contingencies. So what I did is I backed it out of all of it, out of each of the work packages and out of the reserve contingency, and moved a big chunk of it into the bond financing costs, which is the last line item. And I highlighted that yellow because it went up by over $8 million, right? And now you see, wow, that number is now 9 million something. So that's where we set aside the money that we may need to pay to the government. When Robert and I looked at this and we've read the report, and it said, hey, you owe nothing to the IRS at this point in time. Their evaluation was on a 2-year period, from when the bonds were first sold to May 11th of this past year. And so they looked at what was actually earned, which is just under 4 million at that point, out of that 11. The other is forecasted earnings, and they only evaluate real earnings to a point in time. And so we read the report, looked at it and said, okay, based on our reading of this, without having time to really jump into it with them, it looks like we need to set almost all of it away, and we'll carry just a small piece. And so I had about 1.1 million almost 1.2 million that I left in our reserve contingency. You can see it says it's 1.6, about 1.2 of that was earnings from the investments. And everything else we put down below, saying, hey, we really need to hold off on this. And that was almost 9 million, and it adds up to the 11 million.
That's for the entire project period.
Yeah, yeah. So we're forecasting, hey, we're not gonna be able to use any of those funds.
Right.
And that's how I set it up. And then in my write-up, I tried to show you each number going in and out of all those. And I won't take you through every one of those steps unless you have questions on it. But that's how I move the money out of where, so that one, we wouldn't be thinking we could spend it as contingency, but that we're thinking of it as a liability and an obligation to pay. I will tell you that after I did my report, Robert and I had scheduled a meeting with bond counsel to go through and really talk through the arbitrage report, make sure we were interpreting it correct and understanding it correct. And we were too conservative. And they came back and said, no, what this says and what this means is these dollars are all available to you to use. And in next month's report, you will see that I actually moved 2.8 million out of that liability line item back into contingency. And was just as how they presented their numbers needed some interpretation and them telling us exactly what that meant. It just happened after I submitted my report. And like I said, our first reading, we wanted to be very, very conservative. But then they clarified and confirmed and said, no, the reason you have no tax liability now is these funds are all available to you. So the earnings to date are available. What we did with anything that's forecasted is put in as a liability, 100%. It is not likely it'll be 100%, but until they do their report, we won't be forecasting any of that usage. They'll, arbitrage, we'll do it annually. So we'll get another report next year based on earnings through May 11th. It's the anniversary date that they use it on. And so that's what's going on with that. That was the big change I had, but it's also a positive in that it goes back, because what it means on our contingency, on back to the second page of that report, our contingency is shown as currently 13,478,000 total combined contingency at 5.87%. Just this actually puts that back up at 16,280,000 when I make the correction next month. And that'll put us back up over 7% contingency at that point. Question?
We're not going to arbitrage for, 5 years?
That's right.
Right. So you were taking it as of now, you're not, okay. So what they're saying is until the 5-year period comes, this interest is yours no matter what.
Yeah.
Yeah.
Yeah, and as Greg said, they can't make any claims about future earnings, because we could cash all of those investments out now. And so they're not going to make a statement about what happens if we hold it to maturity.
Right.
There's no guarantee.
We're not going to do that.
No.
But you relook at it every year.
Yes.
So that you
Yeah.
know if we need to shift.
Yeah.
That's good.
Yeah. And it was a really helpful meeting, going through their report and making sure we understood it. It's sometimes what their words mean. We took some things meaning reverse of what they were. But they said, no, that's all good news right there. And so it was a very pleasant surprise and nice meeting to go through. So we're in good shape on that, which means we're really in better shape than what I had predicted in this report. The only other there's a few little changes in there. some hard costs and soft costs, outside of the insurance and the adjustment of the earnings. They were generally for anticipated, I think like on Redmond, I was looking at my budget and what the authorization level was, I was like $3,400 lower, and I just wanted to get it balanced. So when I look at my number, I know that's what you approved as an authorization level, and it helps me monitor how we are committing to costs and expending those costs. And so there's a couple of those, with Sisters and Lapine, we've started the project closeout process with SunWest Builders on their contract. And very happy with how that's going and how the final costs are coming in. They really worked very well with us on managing costs within the GMP, even costs for changes we asked them to make. They were able to with contingencies that we had in there, and they worked with us. And it's the way the form of contract is set up, it's meant to do this and allows us to not always have to increase the GMP unless we need to. And so as we go through the final accounting, you can see I made a couple of adjustments with one of Lapine is slightly under budget and Sisters is slightly over budget. And it's very small dollars in really the big picture of it after we've accounted for all of our changes. And with Sisters and Lapine, we made a lot of changes because we were figuring out exactly what we wanted in a lot of systems and stuff, and how we were going to do it. And some things that we thought maybe we would buy direct, we had a contractor buy on some AV pieces, and that way they could buy them and put them up for us. It just made better for demands on the district staff. It's why we have contractors let them do that. And so those things, and so those will all come out. I will tell you, we're looking at some additional scope and enhancements that we'll bring to you guys here in December for Sisters and Lapine, and even Sun River around MEP controls, our mechanical system controls and our lighting system controls. And it's, we tried to reuse some stuff when we did it, trying to hold costs down, but also reuse some of the old control systems. And looking back, it may not have been the best decision, because now we're looking at really trying to consolidate control systems across the district, so that whichever building staff walks into, same system, same management, simpler functions. They can use their smartphones and their iPads and that to do it from wherever they're sitting, right? And just do some improvements. And we never hit our contingency for that project because we were able to contain it within the GMPs. So there are some funds there. And so these are some upgrades that are, I think, very valuable upgrades, and we're vetting through them now that we've seen where we're sitting with this and what we're doing on the other libraries, where we've said, okay, we really now know what we want to make sure that the renovations align with the new buildings and what control systems. And so we'll bring that to you in December, and what that means budget wise and scope with authorizations to move forward with that kind of things. But those are some things that we're now looking at for these two facilities. Sun River, same thing, but some of it is very not as big of an impact because we haven't built anything there. And we can make some of those changes at a little bit lower cost. But we'll present all of that to you at that point in time. So that's what's kind of coming up in the budget. Like I said, I didn't go through all of the individual budget changes, but if there's questions, please let me know on that. From procurements and contracts, nothing new this month. Nothing really happening there. Everything that we reviewed with you in the past have been processed and gone through. And so that's on that. On the insurance, we talked about that. We will have our builder's risk policy for Stevens Ranch coming up, and B&B is looking at that. They're getting that ready. We'll probably bring that to you in the January board, maybe December, but most likely in January. We'll want to get it in place when we start our improvements. It doesn't have to be there when we're clearing, grubbing and grading, but when we start putting new things in the ground, that's when you really want it in place. And so that'll really coincide with what Kirby's doing, but that'll be a large one. I think I've got that budgeted. It's over $1 million policy that we'll purchase because of the size of the project. You know, it's a cost that goes along with that. Design and construction, like I said, on Stevens Ranch, 75% CDs are there and going through. That's just a real good coordination set. And again, another budget check that Kirby wanted to do. We had in their contract planned for budgets at 50% CDs, and they said, hey, we're gonna take the 75% and check our numbers again. One, because we brought on some key subs. We're now working with the, amendment 1 that we processed and hired those subs and bringing them on board. They're checking their numbers, and those are big, that was all of our major trades of MEPs and grading and structural with all of the timber and everything else. So another good way for them to check. And then as we analyzed the last budget on 50%, there were some things that Miller Hall brought up of, hey, take a relook at this. We think this is where they're going with the design would help to, just manage costs, bring some things down, some things that they said, I think you missed this. And so it's a really good check that Kirby said, hey, we're going to go do this. So I think that was a good action on their part. And as far as that goes, our early learning and FF&E designs are progressing. Space Saver is doing a budget for us right now on this 75% for all of our shelving systems. So we really double check where we're at, how that's going. The early learning design has progressed as they completed Redmond. They're now into starting the construction documents for Stevens Ranch. And so that's progressing. We'll start doing budgets on that as we go. And that just kind of tracks right behind the building process. So
And those will flow with what we already have.
yeah. Now, if you remember when we saw the DD design, there's some really incredible play structures that are unique. Just like Redmond was different than these branches and then Stevens Ranch. So there's a lot of that and a lot more really cool stuff. Because that's going to be where they really had those large play areas integrated into the whole children's area. So not much with Redmond early learning. Like I said, we'll price that out. It's moving along. No really process changes or plan changes than that. The Sisters in Lapine close out, as we talked about, that's currently in process of wrapping up any last little details, any outstanding items, and then evaluating what we want to do. We had a really good lessons learned on Sisters in Lapine that is really translated over to Sun River already. And I could see it in the team. We had a great, 3-hour discussion of everything that we did and how it went and what could we do differently and have we anticipated these things, these changes or problems over here, not just at Sun River, but at Redmond and beyond. And so the team really, I think, benefited from that. And I'm seeing it in just reading the meeting minutes on Sun River. They're tracking some items and they're talking about them early instead of late in the game. Robert went through, he scrubbed the whole door schedule of exactly how every lock set was going to work. Because that was something that we were trying to figure it out on Sisters and Lapine. And so it came in late. And now we have exactly how we want it. And so he double checked everything. And I thought that was a great exercise. Well, they're doing that on everything. And so just some positives about the collaborative nature of this whole team has been. They had a great walk on Monday this week with the early learning guys and did the same thing. Another review of everything installed at Sisters in Lapine. But how was it working? How was it functioning? What did the librarians like and dislike? And what did the kids break? And why and how? And how are they going to do it differently, right? So it was a great learning opportunity to really put in place as we go forward. And our first two libraries are, I don't want to say guinea pigs, but guinea pigs, right? We've learned a lot off of them, and I can tell you the team is learning from them, and it's not just being forgotten about, but utilized in our planning. So, you know, I think the Lansing's Sun River underway, going well. East Bend, we're doing the evaluation of the scoping. We've talked about that. We've kind of pushed it a little bit to January, simply because with everything going on the 3 branches and the other stuff, we were getting overloaded. And so it's like, okay, we have time, let's not rush it. Let's do a good job and then present it to you in January with, hey, these are the thoughts, and have that discussion of what you think about where you want to go with that. So that's gonna be upcoming, but it's in the works. I think that's kind of everything that I've got. I hope all of the links in the report are working for the pictures and videos, and we're getting more of that stuff, and try and keep giving you as much as I can on that. So, any questions? All right.
Thanks, Rick.
Absolutely. I'm done.
No action needed on that.
No actions this month. It was nice, huh? So not too many numbers. Yes.
And let's see, we have a little bit of a change in our agenda. Before the city of Bend, we're going to insert,
Just wanted to kind of piggyback in what Greg just did. Kind of give you a sense of the scale of what's occurred over the last month and a half. So Mayra and Zoe, and you may have others helping you with this, are this is a presentation they did at our all staff meeting last week, and it's kind of overwhelming to see what you've accomplished. So, good.
Thanks for that intro, John. So while I do that, I'm gonna go ahead and share screen. I'm gonna share the stage today with several of the supervisors from the sites and just really give an update. I think you all heard from the financial side and then the budget side, and now I get to really share the tangible side of, you know, you all have been making decisions about this, but now there's actual things coming to fruition. And Todd just opened up this opportunity to share that with you all. So let me go ahead and share screen. And we'll hear from several of the supervisors that are involved. And I just want to really quickly call out to those at home. Can you see and can you hear us? All right, I see a thumbs up. I'm gonna roll with that. So I'm gonna give a very brief intro, and then we'll start passing along to some of the folks involved, because why not hear directly from them than just from me? I'll reintroduce myself. My name is Mayra, and I have the pleasure of being library operations manager, and which means I have hands, feet, toes, and every appendage inside all 6 of our branches, and I'm so excited. It makes me very happy. But with that, I'm gonna re-summarize our October, really is what this presentation is for. And so some of you might remember, on October 6th, we soft opened Lapine, and you all got to have the board meeting from there. We don't waste time, and you'll notice a trend, about every 4 days, we were doing something different. So, so by the end of this, if you are exhausted for us, we will take all of your sympathy. So let's jump right in. My jumping in is gonna be with an introduction to Sonia, who is our Redmond supervisor. And Sonia's gonna share a little bit about the Redmond topping out that happened on October 10th, just 4 days after our soft open in Lapine. Take it away, Sonia.
Thanks, Mayra. And again, I'm Sonia Branges. I'm the library operations supervisor for Redmond, if I haven't met you. It may come as a surprise, but I'm not going to share anything about budgets or balance sheets right now. As I said before, I said this in another presentation, but I think it's so appropriate. And paraphrasing, Crosby, Stills, Nash and Young, our house is a very, very, very fine house. If you've had the opportunity to go by the site, it's just fantastic. a few weeks ago, I guess almost a month now, through some luck and some amazing teamwork, we were able to attend the topping out celebration as a Redmond team. Members of management and the district were there. Kirby was there. The trades were there. It was a great event. For those of you who don't know, I did a little bit of research in true library style, and a topping out celebration is a Scandinavian event that a tree is placed on top of the building as they start to close it off the top, as you can see there. And that is to a tradition to appease the spirits of displaced trees during the construction. It was a really awesome day to bring everyone together and see the progress. And that piece you see on the right there is kind of one of the final pieces of underlayment going on under the roof. So that is a big milestone for the project. It kind of denotes the next part of going into construction in sort of a drier environment for the winter and the inclement weather. And I know the construction workers that we saw the other day were very happy that this was moving into that phase, and talking about ways to warm it up inside there while they're still working. So after those that piece was getting prepared to go up there, we had an opportunity to all sign it. And then through a collaborative effort with the wonderful Sisters team, who was in their temporary downtime right before their open, they came over and subbed in over here at the Redmond location so that our team could go experience some of the new things coming their way that were already in place in Lapine. So they got hands-on opportunity, and you can see they were having a lot of fun with that stuff. I've been able to take a few tours with Mark Levitt and Caitlin at KNCC to keep on top of what's happening out there with the project. We've gone over there with a couple different points of view. Presently, I'm working on the creative space project team, where we're going to kind of decide how we're going to operate in that new wonderful creative space that we have set aside at Redmond. And so we've been able to walk that as a team and kind of get a better visual on what that space is really going to feel like. I just want to say that the efforts that the Redmond staff and all of DPL have put forth to create these opportunities for everyone to become involved, all staff to become involved with the planning, the design, and the construction parts of the project, are just going to result in this team that is so incredibly interwoven and connected to their buildings. We always give great customer service, but this is just going to be next level. With new buildings opening and staff so connected to the entire process, we're just so headed in the right direction. So I can't thank everyone for all their efforts, but we're really excited at Redmond.
Thanks for those highlights, Sonia. So that will transition us over to 4 days later, where on Saturday, October 14th, we had the first grand opening at Lapine for these projects. And so with that, I'll transition it over to Kathy, who will tell us a little bit about it. This was a pretty big day. It was also Eclipse Day. So we had lots going on. And Kathy, if you're ready, take it away.
I'm ready. Hi, I'm Kathy Zagrogan, and I've been the supervisor here in Lapine for around 15 years. And to have the opportunity to be part of this brand new building is just spectacular. We had probably 300 people in an hour and a half for our open house. They enjoyed ribbon cutting, face painting, the lovely balloons at our entrance. They had balloon tying and snacks and music, and it was just a really wonderful day. It had been a long time coming. We needed it here. We needed a reopening in Lapine. What else? We have been enjoying the clientele and so many new people who have been coming into our building asking for new cards or replacement cards because theirs were expired, and we have teens and we have adults, we have children with their parents enjoying the kids area, the landforms and the trailheads and the brand new carts to play with. Everything's been just running pretty smoothly. We have a few hiccups here and there, but it's a new building. We're expected to have that. Staff, we have a blend of veterans here and brand new staff. Jennifer has come from Sun River, and Nicole is new, and Kaylin has been here for 10 years working with me in La Pine. We are so excited to have our customers back and to offer them, as Sonia said, the best customer service we can possibly offer. And I thank you for your time and letting me chat with you.
Thanks so much, Kathy. So if you all think I'm gonna say we did something 4 days later, that is not true, completely false. We did another thing that same day. So Saturday, October 14th was massive, and we tried to one-up ourselves. So I'm gonna turn it over to Heidi. Heidi Powers is a Sun River supervisor. Heidi, tell us a little bit about your journey from October 14th through October 24th.
We've had an excellent journey. And are so excited about just the opportunity that we have this space for our community. Staff has done really well with the move over. Our customers have been really gracious. They have been concerned with how staff is doing. They always ask them that. They are very grateful that they have a place to pick up their holds and drop off their materials, and use our office space if they need to do the copying and fax. That's a highlight. We have, it has been very smooth for us. Kathy and Zoe have really done the hard work to start with. It was only 22 degrees this morning, and the trailer was just fine. We were just fine this morning. So that is really good. I did want to share something that I shared on Friday, just a little shout out for Red Point and Prestige, that the people that they had brought in to help do our moving were so helpful and so sweet. And that repeatedly I would have my arms loaded with stuff to move over to the trailer, and they would just take it from me and move it for me. You know, where do you want it? What can I do? And I just think that that was just such awesome service that they gave to us. And of course, our facilities and our IT folks, they're always so great to work with, so kind and helpful, and always want to make sure that everything's working for us. And I just really appreciate that, and just give a shout out to all that. All in all, it's going really well, and we're looking forward to a very cozy winter. And even though I often hear, oh, it's just for a short time that you're there, it's all winter. We're going to be there all winter. And so the snow hasn't even come yet. I just can't even imagine the tiny little parking lot and snow. So we'll see how it goes. But thanks for letting me share.
Thanks, Heidi, and kudos to you and your whole team. It's Heidi and 2 other staff members, Annie and Beth, and they'll keep that temp space running for us. It is, if it feels a little familiar, it is the temp space that was here in Sisters, and they have managed to make it look completely different, even though it has the same layout and everything. So it's nice to see that they have made it their own. So with that, we'll keep transitioning. This time around, we did give ourselves a bit of a break. So from the 14th to the 24th, we transitioned, we emptied out the Sun River building, reinstated the temp space. And then on the 28th, this one over, Zoe, I present to you Zoe, she's here in person. Zoe is gonna tell you a little bit about the Sisters grand opening.
So welcome, I'm excited to show you around the physical building, so I hope you all can stay after the meeting. So yes, we did, we reopened on the 28th. However, our soft opening was on Tuesday, the 24th. So staff and I, we, took our temperature, do we dip our toe in? Do we not? We decided about 1:30 in the afternoon. Let's go for it. So what I had in the front of the building was a sandwich board, and we had the vinyls up on the door. So I went out, removed the vinyls off the door, and I moved the sandwich board off to the side.
kid you not, within about 5 minutes, we had our first customers. It was a teenager with his father. Then within probably another 5 to 10 minutes, we had a couple of other people trickle in. Our third customer of the day, he made it a point to tell me that he had been watching that sandwich board all day. And I was going in. So by Thursday, the word was out, Sisters is open. Staff and I began to question, oh my gosh, what are we going to do if everyone that has telling us we're gonna be there Saturday arrives? Where are we gonna put them all? So Saturday arrived, we woke up to 17 degrees. It was very cold outside. We had to put off hanging the wonderful balloons until the temperature rose enough to where it would be, they wouldn't pop or deflate or whatever they do. So by noon, I don't know, Todd, what would you say? It was maybe 30 degrees. But
All the audience was in the sun.
yes, and we were blocking the road. So in the 2 hours of our grand reopening, we saw 550 folks come through the building. We also estimated we issued brand new library cards, about 35 to 40. Okay?
Nice.
So, community relations, they did an awesome job. And as you kind of picked up right by what we've all been saying, this is an all hands on deck. And we are most appreciative to our vendors, contractors, you all even. So all of our people that we work with, because yes, it takes a village to do all that we've done. So what you'll see here, we did have the same program that Lapine did. We have a face painter, we had a balloon artist, which by the way, he was the most popular. You can see our own Graham was helping out making ribbon wands, which were great fun. We had refreshments. One little anecdote that was shared with me later on. So when we get over into the children's room, you'll see that we have a kitchen play center in our early learning space. So I have refreshments set up here. Someone noticed one of our youngsters that was joining us. She had taken her cookie. It was on a plate. She went over to the kitchen in the early learning space and put it in the microwave. She was going to warm her cookie. It was cold outside. So, you can see, yes, there's the kitchen plate. I don't know if that was her cookie plate, but yes. So, we had a wonderful time. Staff and even our construction superintendent, we invited him. He doesn't shared with us, he doesn't often get to see the after effects of his work. It was wonderful to watch the community come together. They supported us the entire time we were in the temp space. Mind you, we could only have a maximum of 9 people in the building at any given time. There was questions going into the summer reading program. Would we have any participation? The Sisters Community's credit, we increased our participation numbers over last year. So, and yes, guess what? They're all back. Our attendance right now, we're averaging about 150 to 200 people a day. So, and we keep issuing library cards. One other observation that staff made last week was folks that were here on Saturday have been coming back in with a guest, be it a neighbor, a family member, you know, so the word's very much so getting out. One piece I'd like to share. So I have a personal connection to this building. So I've been supervisor here for 19 years. I moved here, Todd shaking his head. I was transferred from Redmond to Sisters 6 weeks before we actually opened this building. So my first project that was assigned to me was moving the collection. And at that point, we did it in-house. Facilities, and I had a staff of volunteers that we trained. We allowed ourselves 7 days to move in. We did it in 4. This go around, like Heidi said, Prestige and Red Point, they're amazing. They're awesome. And it was very nice to be able to just relax and kind of sit back and let some others do the heavy lifting. So I have now, 3 moves under my belt on. I've asked that you don't do that for a while.
Alrighty, and then some final anecdotes to share. Wells, I was a little too humble. In the middle of a grand opening, she finds time to do TV interviews as well. So we just wanted to honor the amount of work that, you know, staff, supervisors, and everyone on site were doing. And with that, we just wanted to end in the theme of the month with really a moment of gratitude to give thanks. As you've heard a lot of my colleagues say, this is not an easy lift. We could not find a single crevice of DPL or staff that wasn't impacted, even if you were customer facing or not. So I think just to draw it back of, we have all pitched in, we've all lifted, but it definitely is something, a moment of gratitude to you all, because these are decisions you all make that allow us to make that come to fruition. And so just kind of a reminder, we wanted to acknowledge, you know, all the faces behind DPL and all the work that goes in, and thank you all for letting us do it, especially as we move forward with Sun River, Redmond, and then all those that follow. Any questions I can answer, or?
This was great.
No, thank you for sharing this.
Absolutely. Just wanted to highlight, you know, why we're all exhausted. No. And we're all very much in favor of a restful November. We are not doing another busy October. Thank you.
Thank you. That was great.
Okay, we'll move right along to City of Bend multiple unit property tax exemption.
Okay. Cate, are you hearing us?
Yes, can you hear me?
Yeah.
All right, thank you for having us. I'll go ahead and share my screen here. All right. Is that coming through okay?
Yes.
All right, well, good afternoon. My name is Cate Schneider. I'm a senior management analyst with the City of Bend. And thank you for having us today. I know you've been meeting for several hours, so I'll try to be concise, but I'm here today to present the multiple unit property tax exemption, which is a mouthful, also known as MUPTE, application for 105 Northeast Franklin Avenue for your consideration. The project is proposing 2 new multi-story buildings with 199 residential units. And with me today is Carolyn Baggett of Project PDX representing the applicant. So she'll provide an overview of the project itself. My plan is to just give you a quick overview of what the MUPTE program is and what it requires for a project, and then touch on how this project meets the requirements. And then I'll turn it over to Caroline to tell you more about the specifics. So what is MUPTE? It was adopted a little over a year ago in August of 2022. It is a tool designed to incentivize multi-unit housing development in certain transit-oriented and core areas. Big picture, the goal is that we want to incentivize multi-story residential development. We have a comp plan commitment to try and add housing in the core area, and MUPTE is a tool that helps us reach that goal. The program itself, as I said, was adopted last year and it will expire in 2030. The tool itself is a 10-year property tax exemption on residential improvements. To receive the full exemption, the project must be approved by taxing districts representing 51% of the combined levy, but we're working to secure approval from all the taxing jurisdictions for this project. So programs, applications must meet a number of requirements to qualify for MUPTE. So you're looking here at a list of those requirements. It must be new residential development. It must include 3 or more residential units. There's a multi-story requirement, and depending on the lot size, that's either a minimum of 3 or 2 stories. Hotels, motels, and short-term rentals are not eligible for the program. Projects must provide 3 public benefits, and I'll talk more about that in a future slide. Any project must provide justification if they're eliminating any existing housing or businesses on the site and describe what steps they took to try and mitigate that displacement. And then finally, they must submit pro formas that demonstrate the project would not be possible but for the tax exemption. And the city hires an independent third-party financial consultant to review those. Projects to be eligible for MUPTE must be located in certain areas. So you see here, eligible zones, so the entire core area tax increment finance or TIF district, excluding the MR zone, the central business district downtown, high density residential area zones, and then urban dwelling sites, and those actually aren't depicted on this map. I mentioned that it must provide 3 public benefits. So of those 3 benefits, project must provide at least 1 priority benefit. So priority benefits range from affordable housing to childcare to a high standard of energy efficiency. And then the project must select at least 2 additional public benefits to provide. And you can see there's a list here ranging from transit supportive amenities to enhanced landscaping and EV charging infrastructure. So turning to this specific project, based on the application materials submitted by the applicant, the findings of the independent financial review, and findings of the staff review, this project meets all of the applicable criteria for approval. Highlights of what this project is proposing are included here on this slide. So it'll be 2 new 5-story multifamily buildings with 199 residential units. It's located in the core area tax increment finance district. The site's currently unoccupied, so there are no displacements. It is providing 3 public benefits. Its priority public benefit is a high standard of energy efficiency through Earth Advantage Platinum certification, enhanced landscaping, so native and pollinator friendly plants, and then EV electrical vehicle charging infrastructure. It will provide at least 50% of the total parking spaces with EV charging infrastructure. And then finally, as I mentioned, financial analysis is required, and there was one for this project that confirmed that it is not viable without MUPTE. So the city contracts with an independent third-party financial consultant. In this case, it was Jerry Johnson of Johnson Economics, who reviewed the project pro formas. They found that the project would not be viable without MUPTE, that the indicated returns are below what would be considered adequate to incur the development risk for this project, and that MUPTE would likely make the project viable, but the margins are still tight. And then lastly, I wanted to touch on the financial impacts of offering a 10-year property tax exemption. So first, it's important to note that the property is in the core area TIF area. So the financial impact of the exemption is only to the Bend Urban Renewal Agency TIF fund. There's no direct financial impact to the library because the project is in the TIF district. So you see here before you what the estimated amounts exemptions are for this project. So it's estimated, if it's approved, that it would receive approximately $4.4 million in property tax exemption over the 10-year exemption. The estimated 10-year property tax collection with the exemption in place is $1.2 million. And we estimate that if the project were to not move forward and no new development took place, the 10-year property tax collection for this site would be $585,000. And with that, I'll turn it over to Caroline, who's going to actually walk you through the project itself.
Hi, good afternoon. I can present my screen really quickly. Sorry. All right. My name is, as Kate mentioned, my name is Caroline Baggett, and I am a development manager for Project. Project is a values-driven real estate developer that focuses on maximizing environmental, social, and economic benefits inherent in meaningful places. You might be familiar with some of the previous work we've done in Bend, which include projects such as Base Camp Townhouses and the Grove and Northwest Crossing, which I will reference again in a little bit. Today, I'm going to just give you a brief highlight of the project and kind of the benefits to both library and the community at large. We'll review the financials and with an emphasis on how MUPTE approval is needed for this project to proceed. And then I'll open it up to any questions that you all have. So as Cate mentioned, the project is located at 105 Northeast Franklin. So it's bounded by Northeast Franklin Avenue to the north, Northeast Emerson to the southeast, and the railroad tracks to the west. The site used to be the home of Les Schwab, their primary Bend or Central Oregon location, until they moved recently to Northeast 3rd Street in Bend. Our property is located in the Bend Central District overlay, as well as the core area tax increment finance or TIF area. So the BCD or the Bend Central District is what's in orange here, which is an area that the city has identified as an opportunity area to direct growth and density. And the TIF, as Cate mentioned, is a 30-year redevelopment finance program to reinvest or rebuild parts of the city to achieve the urban changes needed to accomplish the city's growth plans. MUPTE, as Cate mentioned, is a 10-year tax abatement within that 30-year TIF program. Therefore, libraries won't see a direct loss of tax revenue from the project. So this is just a brief site plan. The project consists of the demo of 4 existing warehouse buildings, and then the construction of 2 new 5-story residential buildings along the west side of the property. It includes surface parking, public plaza space, a pedestrian-focused First Street extension, and then it also has this east building that's going to be kind of refurbished, although there's no residential component to that building, so it's not part of our MUPTE application. The north building will be about 80,000 square feet and house 100 housing units and 5,000 square foot of retail space, which is a code requirement for kind of the frontage along Franklin. And the south building will also be about 80,000 square feet and hold 99 housing units. All units are planned to be for rent, so a total of 199 units. This image is kind of a overview looking west at the 2 residential buildings. So the north and the south building, you can see the First Street extension here and kind of that public plaza space. And then the surface parking will all be kind of to the south of the property or back behind the residential buildings between the highway and the train tracks and the property. The next image I want to show you. So this is showing the interest of the property off of Franklin onto that new pedestrian-focused First Street. The street is designed to reduce speeds coming onto the site. So you can kind of see the curve here as you come off of Franklin, and provide connectivity to the city's upcoming Franklin Avenue improvements and prioritize pedestrian and biker access and usability. As I mentioned before, this building to the left of the screen here is the existing Les Schwab tire shop that will be renovated as a commercial space, but that portion is not included in our MUPTE application as it's not housing related. Sorry, my mouse is just not cooperating today. This image is just showing a portion of the public plaza space featuring native landscaping. There's going to be benches and spaces for gathering, fire pit, opportunities for pop-up events and performances. The space will be open 24/7 with access to the public. There's outlets and work areas included so people can work remotely. Like I said, we can have events like farmers markets or music, things like that are kind of all incorporated into the design of this space. And then the public benefits that our project is offering for the, per the MUPTE requirements are the high standard of energy efficiency. So Earth Advantage Platinum certification for both of these buildings. Enhanced landscaping, so we'll be utilizing all native and pollinator friendly plants across the site, and electric vehicle charging. So 50% of our parking spaces, which is a total of 65 parking spaces, will be EV charging ready or already have the EV charging in place. And then this last image I wanted to show is just the first kind of the other direction of the property, looking on First Street up toward Franklin. Again, you can see the renovated Les Schwab building to the right, which is not part of the application. And just kind of wanting to showcase how pedestrian focused this First Street extension is going to be. It's going to be limited, if any, curbs. So really easy access for pedestrians kind of crossing from the public space into the housing units or into the commercial and retail space across the street. So when we submitted our MUPTE application in May, we had included 2 pro formas, one showing the project with MUPTE and one without. And our construction pricing at the time was based on estimates from 3 general contractors, all of which the estimates came back within 2% of each other, and they were based on our design development drawings at the time. As Cate mentioned, the performers were reviewed by the third-party consultant, which concluded that the project did not represent a viable development program without MUPTE. Since this submission and third-party review, the market, as we've heard even today, has continued to decline and interest rates have continued to go up, which is increasing the cost of development and reducing our return on costs. At the time of our application, we assumed a construction interest rate of 5.75%. Now that rate is closer to 7.5% or higher. So without MUPTE and with the highest interest rates, we're still achieving, without MUPTE and with the highest interest rates, we're still achieving a return on cost below 4%, even with the additional 8 units we've added since our application in May. And so really across the board in Bend, in Central Oregon, and nationally, projects are going on hold as very few are feasible to build right now without support. And that's why it's support from the city and the Deschutes County libraries and through programs like MUPTE are so necessary to keep critical and catalytic projects like ours moving forward. It's going to take a catalytic project with a big investment to spur the desired growth in the Bend Central District. And our project at about a $75 million investment is the type of catalytic project needed to bolster that development and really provide the necessary housing needed in the area. With that, I will open it up for any questions.
I have 2 questions. One, out of the requirements that you had, and you had to take, I think, 2 or 3 of those requirements, it seems like this project takes 3 of the easiest ones, the EV chargers, the landscaping, etc. You didn't choose to have low-cost housing or even middle-income housing, which seems much more important in this environment.
So our stance as developers of all types of housing is that we need all levels of housing in a housing crisis. If we built only affordable housing, then all the people that could afford a higher level of rent or income would be, utilizing that housing and pricing out the people that need that affordable housing. And I think one of the benefits of this, the way this MUPTE program has been set up, is it allows us to focus on a lot of priorities for the community, kind of other than affordable housing. So there's big cost implications of doing things like the Earth Advantage Platinum construction, that benefit the longevity of these projects and the quality of life for the residents that live there and around it. Items like the landscaping in this public plaza that we have, will really benefit the community, especially in this area where there's not, a lot of green space or public gathering spots. And so, you know, our focus has been on kind of those other, like you mentioned, other benefits that were options on the MUPTE, which because of the cost of those drives us to a more market rate rent level. But again, still providing housing at a level that is needed in the community. Just to kind of, I guess, counter that point for us is we have a similar, or not a similar, we have another project happening in Bend right now, kind of on the other side of town that's going to provide workforce housing, you know, so a different kind of income level of housing, you know, project that we're doing just on the other side of town.
So you didn't choose to do any portion, just a portion of it as affordable housing?
That's correct, yeah.
My second question is 65 parking spaces seems fairly low for 280 something units. Where do these people park?
So we have 117 total parking spaces allocated specifically to the residential building. Across the site, I think we have closer to 160 parking spaces, but the way that the property is divided between kind of that commercial space and the residential space, it's just kind of how the counts are delineated. And so then the MUPTE requirement is 50% of those, minimum 50% of those parking spaces allocated to the housing need to be EV charging ready. And so we have 65 of the 117 spaces will either have EV charging in place or be infrastructure ready to add that down the road.
And that meets the city of Bend parking requirements for a unit like that?
Yeah, actually, the city right now has no minimum parking requirement for new development.
Okay, thank you.
What are your anticipated rent levels based on your financial performance?
So we're market rate rent. Let me see if I don't have that pulled up handy. So we have studio, 1 bedroom and 2 bedroom apartments. And I believe they range from a little over $1,000 for the studios and up to maybe $2,400 for the 2 bedrooms. I believe that's in our application, but I can pull that up as well as if there are any other questions.
Any other questions? Watch these things.
Oh, yeah.
Go ahead.
I'm concerned with your ingress and egress. Franklin is an underpass there, which is a blind spot coming out of your development. If there anybody was to exit onto Franklin, how are you going to mitigate the blind spot of Franklin?
So we have, I think the requirement from the city is that the entrance from Franklin is a right in, right out. So there's no ability for anyone to turn left out of our first street onto Franklin. So that's one side of it. And then the city has also been approved to move forward with other improvements on Franklin. So I know that underpass will still exist, but I think there's plans to kind of expand the pedestrian access, which should kind of clear out and give a little bit more clearance, you know, rather than the building kind of right up to the street as it sits now. There'll be more visibility to kind of around that intersection.
Understanding that the pedestrian improvements will be on the overpass. It's not on the street itself, it's on the side, the elevated section where the pedestrians are right now. So I don't see how that's going to improve your sight, line of sight on Franklin for cars.
Yeah, I'm not totally sure what the current plans are. I think the last that I've heard, you know, we've been given different setbacks than what we had originally planned for kind of a wider, and I can go back to the image I showed before, which might be helpful. But yeah, like a wider pedestrian walking path along.
So if the first street is a right in, right out, emergency vehicles have to come from downtown to get to you.
Coming from downtown, they can turn right onto First Street.
Coming from any other direction, they can't turn in.
Correct. They'll have to come in through Emerson.
And First Street, is it going to continue on to where, going south? Because it ends up at, I think right now, Weimar.
That's correct. So we'll extend it through the end of our property, which is like right behind that, the Weimar property. And then we'll extend it to connect to Emerson on the east side of the property. So I don't know what the plan is right now to extend beyond our property line.
So it'll end up in T at Emerson.
Right, until it's fully extended to the next property, it'll be, you know, people will be forced to turn out through Emerson.
So I understand the fire marshal has review over the property, but also, but he has authority over the roadways. What's the fire marshal said about First Street, Emerson, Franklin?
Yeah, we're meeting all the, I'm sorry, I cut you off. What was the last portion of your question?
I mean, there's a lot of residences in here, a lot of vehicle traffic. If there's emergency service required, what's the fire marshal said about the roadways?
Yeah, we did a traffic study as part of our land use submission, which was all approved. So we're meeting all, you know, emergency vehicle turn radiuses. You know, our design will reflect the impact of additional traffic driven by our development. So that was all approved through our land use application.
I think it would be the vehicular traffic and morning and evening rush hour coming out of this, going back into this development. If the entrance has got to be right turn in from Franklin and somehow getting into Emerson, it comes off of 3rd Street. How are you going to mitigate the amount of traffic stuck at both intersections?
I'd have to defer back to our traffic plan that we submitted, but what we have planned right now, the way that our roads are laid out, like I said, the entrance from Franklin, the slowing of the traffic through our site is kind of all in compliance with the requirements that the city has put forward so far. I can happy to follow up if there's questions that I can, you know, share from the traffic report. It's a pretty hefty report, but I can circle back if needed.
I just have a general question for our board, and that is, the city has implemented the MUPTE program. We as a special district, they're bringing these to us because they're asking each special district to vote on them. My concern is we're not urban planners. And really what we're looking at is what's the tax implication for us. And a couple of things. One, if they get 5 more applications in the next 2 months, or do you want to hear one of them? Well, I know the city's working on some other way to do this, but I'm concerned about it taking up our time as a board when we've just been sitting here for 5 hours. So I'm not sure where I'm going with this, but I need to get a direction from the board about how much of this information you want to hear in the future, how far you want to go into these discussions, because they're interesting, but they're completely off of what we normally do.
Also, we don't make a decision on any of this, do we?
Well, no. All we're making a decision, are we okay with allowing them the tax rebate or not?
Right, because they're taking our.
I can tell you, I know the Parks and Rec, I don't think approved this one. They need, basically, they just need the school district and the county.
No,
they're over 50%.
Right.
And so that's a piece that I've been struggling with for us, is how much time and investment we want to put into this. This is the first application that's come up in a year and a half. We had one once before, but it is a struggle for us because of the amount of time it takes.
Well, and in the past, I think the board has taken a stance not to comment at all, neither to support or oppose this type of request. And I mean, that was a while ago, so I don't know whether that's, I mean,
Up to the board.
yeah, it's so, I mean, that's another alternative is not to render an opinion.
I think that was for that particular, that specific request.
That was for an urban renewal district.
Yeah, maybe.
Todd, you had raised the question of what's the tax implication to the district.
Right.
It may have gone past quickly, but it sounded like
Zero.
there's no tax implication because it's inside the TIF. So that decision's already basically been made.
Right. It's the cities. They were.
To say there's no tax implication is not categorically correct because there is a tax implication for the TIF as a whole.
That's true, but this decision.
But this decision doesn't have any.
Yeah.
By forming that tax district, they've already taken our money.
Right.
So we already heard a presentation on that. We
Right,
already took our money, so I guess I don't understand why we're.
Because they're required by law to go to each of the districts and they could go to the school district and the county and be done with it. The school district doesn't want to be in that position, and so they've been asking, what are all the other special districts doing? I kind of brought this one forward so that, one, we can answer this question, but also, in general, I need to know how to.
I feel like we have enough on our plate.
Yeah, do we need to have this discussion right now, or can we let the developer and others?
I need to be prepared when they come next week.
Right, I'm not saying don't have the discussion, but I don't know that they need to be a party to all of this.
Thank you, sorry about that. Yes.
And at this point, you said Ben Park and Rec has not approved.
I believe Cate can probably give us.
They did approve, Carolyn.
They did?
They did.
All right. Okay, so that gives you, and they had I believe, a similar presentation.
So
And
our
the county, well,
And the county, yeah.
Okay.
So it's-
So,
yeah.
not much.
Yeah, actually, it makes no difference what you say, it's
Right,
true. And there's no tax consequence.
Yes.
But I heard Kate saying that they, on this one, they would like to have all the districts approved. Because I guess it is a rather controversial development.
So
It's
The point already.
it's the, I guess, to back up for just a second, a project could receive the full tax exemption as long as it got approval from tax districts representing 51% of the tax levy. So in our case here locally, that 51% would be achieved with the city and school district approving. However, the school district has been clear that they didn't want to be in the position of approving on behalf of the other districts. So that's the reason we're in front of you today is really that the school district would like to know that there's support from the other districts before they vote. And you're completely right that the preferred method of handling these would be to approve it at the policy level so that all of the board time, not just yours, but all the taxing districts wouldn't have to be so taken up by reviewing project by project. We've realized since implementing the program that we're to better achieve the intent of the statute, we actually should have the policy level approval, not be going project by project. And so that's what we're working towards, and that's what we'd like to achieve so that we could, because you're right, it's very time consuming. But where we are today is with the project by project, so that's why we're before you.
Sorry, I forgot to lead with that you were doing that policy level piece. So maybe at this point, it might be helpful to see if we have a motion, and then have discussion. If there's a second, have discussion.
And as I see it, we can either approve this project, disapprove this project, or do nothing.
Right.
Yeah, or somebody, and do nothing could probably be somebody calling for a motion and nobody seconding it, but that's an option too.
There's no motion.
Yeah, that's true.
Okay, do I have a motion on this project? Do I have a motion to approve or disapprove?
So I make the motion to disapprove.
Okay. Give me a second. Okay. Motion.
Okay,
There's no action.
okay, so. Kate, I guess what we just, there is, basically the board has decided not to make a decision on this project. But thank you for the presentation, and that was very helpful to know what the process is looking like for the future.
Yes, thank you for your time and for putting us on the agenda.
Okay, thank you.
Thank you.
Thank you.
Wow.
So you're saying this is going to come before you again, they're gonna ask you where,
What they're trying to do is come up with a, basically there's policy level discussion, so that we can make policy level decision covering any future, instead of having to go to each
Right.
individual one. Now, they're not getting that many, but, again, it's kind of beyond our scope.
Who sets the 51%? Who sets up the structure for this? Is this the state or?
I believe Kate can answer that. She's still there. Did you hear that question, Kate?
I did, yes, that's by state statute, correct?
Yeah, I assumed that was the case.
Okay. Okay,
Okay, thank
moving
you.
along.
Yes.
Updates on library minutes.
You've got our update, except we would love to, show you our library and some of our new toys that we got since the grand opening. So.
Okay. Foundation news, Ann.
We are as the large banner in the entry indicated, we're getting ready for our annual novel ID unveiling event, which will be December 2nd at 6 p.m. in the downtown library. And if you've never come to this party, it is really worth the trip. It's a lot of fun. So we'll find out what the 2024 novel idea book will be.
what about author?
So author, we're just figuring out, we are doing it this year.
We are gonna have it again this
Yeah,
year.
it's just managing Ben High and trying to get one last date. Just kidding.
But we're almost
Almost there.
almost
And
there.
we'll have 3 authors. We're going to announce those at the unveil.
Oh, with the,
At the
novel
novel
idea?
idea unveil, yeah.
One more reason.
Yes.
That's it, Ann.
That's it. That's all I've got, unless Chantal has anything else.
Any critical communication?
No, I did not, identify anything this week.
Self-review the meeting. Right.
Long, but very worthwhile meeting. Thank you, Robert. Excellent presentation. And great. Happy to see that we thought about setting aside for the arbitrage. That's done. I think the presentation went very well. Worthwhile doing. And thank you for the audit. It's just my mind is nitpicking. There's nothing really inappropriately done.
Cynthia.
A long meeting, but a lot of information, heard a lot of things were good, and I really appreciated hearing the joyful celebration, so that's what's keeps us going.
Yeah, ditto. I think it really, your presentation in particular really showed in visible form, all the hard work that's been going in behind the scenes to make all of this possible. I mean, the staff has really pulled together, it sounds like, and is really, it just takes, there's so much detail work and so much, that we don't ever see. And I just really want to salute the staff for all the hard work that they've put in, and then not just staff, but everyone involved in the projects, because your reports always highlight to me, that we have a steady hand on the tiller, which I really appreciate, and that just the good coordination between our architects and our contractors and everybody involved in the building projects. And thank you for your clear explanations, Robert. You made comprehensible a sea of numbers.
I appreciate you giving me 2 hours of your time.
No, it was, but it was like, there were things that I was uncertain about that you explained fully, so thank you for that.
Likewise for your concise, reporting. I'm sure you could have gone on for 6 hours, but thank you for narrowing it down for us. And thank you guys for, telling us about the openings. Again, so that's what keeps us going for you. And the staff has gone well beyond what I think often is even expected of you. So thank you.
Just echo others' comments, but Robert, really thank you for making sense of all of it. Can be a little overwhelming when we get our packet and
Yes.
we see all of that. You do a great job in really making it flow and make sense. And Mayra and Zoe, thank you so much for your presentation, and please let your staff and the whole library staff know how much the board really appreciates your energy, your enthusiasm, and just the time you guys have spent, to get everything rolling. And thanks, Greg, too, for your update. Really helpful. The links that you send, that's, yeah, helps a lot.
Once upon a time, a long time ago, we had a work session. And we think that was very productive. It's very helpful for us, especially as we start planning for budgeting. And I appreciate your patience. That was a lot to take in, with some really important things to discuss. We definitely packed all the numbers into one meeting.
Yeah.
So thank you. Thanks for your support. It's so exciting to see, and especially I echo you all with the staff reports. It was just amazing. I mean, we lived through it, but to actually realize how much happened in such a, and as Robert said, on all that stuff was, we packed in a staff day right at the beginning of all that as well. Just for extra measure.
All right, well, thank you, everyone, and I will adjourn the meeting.
So if you'd like,